Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading on Francine Lackwin, London, with Tom McKenzie.
And here are your top stories. A roller coaster ride. The S&P 500 stages its biggest turnaround since 2008. US futures point to steep losses, but European contracts look to recover after the worst fall in a year and a half. Eastern Europe on edge. The US puts thousands of troops on alert amid diplomatic efforts to defuse the Russia-Ukraine crisis. Plus, Credit Suisse warning. The embattled lender says fourth quarter profits will be hurt by about 500 million Swiss francs of litigation provisions.
Tom, let's take a look at the futures. Yesterday, we had pretty breathtaking volatility. I mean, I haven't seen anything like it, at least in a decade. And that's really playing out to what we saw, that reversal from 4% to gains in the U.S. Futures in the U.S. are now actually down significantly 1% lower. But it seems that European stocks are catching up a bit.
Yeah, we talked about that move in the S&P 500. The move was even more marked for the Nasdaq as well, moving the biggest move that we've seen since around June of 2001, in the midst, of course, of the dot-com bubble. But then it was back. Losses of more than 5% for the Nasdaq before rallying and ending in the green. So what a session in terms of volatility. And of course, the European stocks yesterday, a lot of bloodletting, down to the lowest levels since about October of 2021. And now we're seeing gains, a bit of catch-up then. The markets and investors weighing up these dual risks, the geopolitics, of course, of Ukraine and the actions by Russia with, of course, what is leading up to this important meeting by the Fed, as ever, and what it means in terms of the direction of travel for rate hikes and the balance sheet as inflation remains at decades highs, of course. The gains of more than 1% across the CAC 40. The Spanish IBEX is in similar territory, posting gains of 0.7%. The UK and the FTSE 100 gains of 0.7 as well. The politics here remains in focus, with Boris Johnson apparently involved in another party. So that scandal continues. We're waiting for the civil servant Sue Gray to publish her report. The Italian FTSE is gaining 0.9%. Of course, the presidential voting continues this week in Italy. We'll see if there's a change in leadership for Mario Draghi. Across the assets, you're looking at futures losses stateside of more than 1%. The US yield currently at 175. Brent and oil, the risky moves around the commodity space, with Goldman Sachs warning that you could see natural gas prices in Europe back to record levels, posting new records if indeed there is a military incursion by Russia. Currently up 0.8% at $86 a barrel, and Bitcoin is at 36,000 after dropping to around 33,000. There's now some view that a new floor has been found for the cryptocurrency of about 30,000. We'll see if that holds. Currently down 2% in today's session. Fran.
Now, let's dig deeper into the sectors. Of course, all these markets on tenterhooks from the Fed, and actually they're also looking at some of the inflation that came out of Australia, which smashed expectations. Now, amongst the ones gaining the most, we have consumer discretionary, up to 1.5%. Information technology is also the second biggest gainer. All sectors, well, most sectors, apart from some of the consumer staples, some of idiosyncratic moves, seem to be gaining. Again, this is on the back of that pretty spectacular rise, Tom, right at the end of the session yesterday in the US.
And in the corporate session, corporate stories, two themes that continue to run for us. It's Credit Suisse, of course, after a very difficult 12 months or so, coming up with this update around the 500 million Swiss franc charge for legal costs resulting from some of the scandals that this bank has been involved with, currently down 0.3%. The Swatch Group beating with their earnings, thanks to, by the way, demand, interestingly, in China and the US, getting more than 2%. That company's earnings back to pre-pandemic levels. And Unilever, More on this story. We're hearing that they are looking to cut the jobs of thousands, we don't have a specific number, of managers for that company after, of course, that failed takeover bid of JSK's consumer unit. And we know, of course, there's an activist investor involved in Unilever. We saw the shares up yesterday, currently down 0.8%. So that is a quick look at some of the big corporate stories, Fran.
Yeah.
But of course, it is geopolitics. It's the Fed leading up to this decision by Jay Powell and the team at the FOMC that is keeping the focus of investors here.
Yeah, I have to say, Unilever actually is one of my favorite stories because you see what they're trying to do and is actually just accelerate decision making, and you kind of wonder, well, now they're getting rid of 1,000 managers, but what were they doing before? And they're also maybe trying to reposition and get out of the market, certainly the countries that possibly they shouldn't have been for at least a couple of years.
Yeah, exactly. There was a focus. They've said that they are going to update us on the strategy for this business. They want to focus on the higher value parts of Unilever and maybe spin off some of the lower value. Of course, the activist investors, according to some of the analysts, are likely to push for a split of that business to create real value. So we'll see, and we'll continue to follow that, Fran.
Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. Credit Suisse is capping a year marred by scandals and turmoil at the top, setting aside 500 million francs for litigation. It also says the key wealth business saw net outflows in the fourth quarter as client activity slowed globally and in Asia. Sources say Unilever plans to cut thousands of management positions to boost decision-making and innovation. The move comes after the activist investor Nelson Peltz built a stake in the London-based consumer goods giant. CEO Alan Jope is under pressure after a failed bid for GlaxoSmithKline's consumer healthcare business. Rio Tinto has struck a deal with Mongolia to start work on a long-delayed copper mine in the south of the country. The agreement sees the cancellation of almost $2.5 billion of debt owed by the Mongolian government for its share of construction costs. Production from the $6.9 billion mine is expected to start next year. IBM has posted its strongest sales growth in 10 years thanks to growing cloud demand. Sales surged by 6.5% in the latest quarter, beating analysts' estimates. IBM's hybrid cloud sales jumped 16%. The latest sign the tech giant's pivot toward newer technologies is bearing fruit. That's the Bloomberg Business Flash. Tom.
Laura Wright here in London. Thank you. Okay, let's get into the key drivers of these markets with our markets editor, Christine Aquina, and Beata Mante, head of European Equity Strategy at Citi. Christine, let's bring you in first. To break down the key themes, of course, we're looking ahead to the Fed, but we also have the geopolitics. Which is the key driver of market sentiment at the moment? Do we have any sense of things are starting to bottom?
Well, Tom, I think this week was meant to be all about the Fed, but then we suddenly got this wrench thrown in the form of geopolitical risks. And I think that really is causing quite a bit of chaos in markets, as we saw in yesterday's price action, because suddenly there's this risk that perhaps was quite underpriced over the last few weeks, suddenly coming to fore and suddenly giving the realization to traders that, hang on, like these markets can't just keep going one way. It has to go the other way. And this might be the risk that finally does that. And definitely questions about whether we're going to be seeing a bottom, at least temporarily. It certainly shows a price action yesterday that the buy the dip strategy is not dead. My only question is, are traders buying the dip all the way into a dead cat bounce? We're still waiting for the verdict on that.
That famous dead cat bounce. Beata, I guess one of the things that we've been trying to figure out is exactly who is selling off and who is buying. And it does seem that it's different group of investors that did the selling and then the buying. What does it give us? I mean, it was really breathtaking, I have to say. I kind of watched from home because of the amount of volatility. Is this going to be a new normal?
Well, what we've seen at the markets yesterday was quite an unprecedented, broad-based sell-off. And I think we have to go back to the source of the volatility. So to us, the main reason for vulnerabilities of the market this year is, coming back to your point about the Fed at the beginning, is tighter. It's just the prospects of higher rates. So we were always worried that the prospects of higher rates, together with quite high valuations for particular parts of the market, would make it vulnerable.
But Beata, is this a transitory change or is it a substantial reconfiguration of these markets now?
So the biggest driver of of the rotation of volatility has been this surge of real yields. And I think this is the key to determine how is the market going to move further. In terms of the overall market, with the current sell-off, our targets for the year end are starting to get much more attractive. So we have 14-15 upside for the European and the US markets right now from yesterday close. But in terms of the leadership, we think that the real yields will continue to move higher. So we have negative 25 basis points in our forecasts for this year. And that would imply that, we are not all the way through the rotation into value out of growth stocks that we have seen so far. So we are perhaps just over halfway there, I would say.
Yeah, and Christine, I guess, the traders were already on tenterhook because of the Federal Reserve tomorrow. And then we had this print in Australia, which actually really saw inflation shoot up. It smashed expectations. Does it mean that we could have another very volatile session today?
Absolutely, Francine. I think what we're really getting in terms of the signals from Asia is this story of inflation being less transitory than maybe policymakers think. And it certainly sets the stage again for that discussion when we start hearing from the Fed tomorrow and the BOE and ECB next week, again, putting into question the nature of inflation and the way that they're going to have to respond to this. Again, it really puts the onus on policymakers to kind of make that decision. Are they going to go through with market expectations for them to start raising rates? The BOE, of course, is expected to do that as early as February, and then the Fed in March. We're definitely watching out for those bets on rate hikes and whether the activity that we saw in markets yesterday kind of calls all of that into question.
Christine, some short positioning around Russian assets as well, Russian equities with ETF inflows.
Absolutely, Tom. And I think it really just speaks to how much the Russia situation is really weighing on markets and sentiment now. This is a Russia-specific ETF, and the inflows initially were quite deceiving, but if you look at the short interest data, it went up to about a third of the float. And that really shows you, people are plowing their money into this ETF, not to buy into Russia, but in fact to short it. And that's very much a reflection of the souring sentiment on Russia at the moment because of this.
Christine, thank you so much, Christine Aquino. And we'll have more after the break with Beate Manthi, a Citi head of European equity strategy. Now, coming up, job cuts at Unilever, the maker of Dove soap and many other household products. I think of Ben & Jerry's ice cream, reportedly planning to cut thousands of management roles. We'll have plenty more on that shortly. This is Bloomberg.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open. We are 13 minutes into the European trading day. Investors making up for some of the losses across the European equity space yesterday. Some, but not all, currently gaining around 1% across the benchmark. Top of the list is the CAC 40 in terms of the major benchmarks above 1%. Sectors, you've got basic resources gaining almost 2%, followed by travel and leisure and banks. Two sectors in the red this morning, food and beverage, personal care and drugs. And of course, the futures stateside still pointing to further losses after that whipsaw, that incredible volatility we saw on Wall Street yesterday. Futures stateside pointing to losses of more than 1%. Fran.
Now, Unilever reportedly planning to cut thousands of management jobs. That news comes as an activist investor, Nelson Peltz, builds a stake in the consumer goods giant, pressuring the chief executive, Alan Jope. Last week, Unilever failed in its bid for GlaxoSmithKline's consumer healthcare business. Well, let's get more on the Unilever story with Bloomberg editor Deirdre Hipwell. Deirdre, thank you so much for joining us. I mean, I don't know whether this is a sign of actually the chief executive just changing things so that he seemed to be changing and so that he gets an easier time from the activist investors, or actually whether this made always perfect sense because they want to rationalize and also just make this, quicker decisions. If you have too many managers, it slows things down.
Of course. I mean, it's been a terrible 2 weeks for Unilever. I mean, Unilever will argue that they have been planning these changes for some time. I think everyone would agree they've allowed some kind of management bloat to creep back into the business. And that can be the kiss of death for a consumer company when you need to react very fast to changing consumer trends. So I think they'll argue that they are removing unnecessary layers of management. And all we know at the moment is that it's low thousands and it'll likely be regional and divisional executives. Of course, what we don't know is when Nelson Peltz's Triumph Fund Management began building its stake, if and when Unilever knew about it. And of course, they'll be wanting to get on the front foot of that. And often operational streamlining is something that activists demand.
Do we have any clarity on what they want, the activists?
Not yet, but what we know from his track record is Nelson Peltz goes into companies and he asks for organizational change, streamlining, reinvigorating brands that maybe are dated. He obviously most recently did that at Procter & Gamble and, with some very good success. Shareholder returns increased during his time there.
Yeah, Deirdre, has something gone wrong at the company? I know you were pointing to the fact that actually they fended off an unsuccessful bid from Croft just a few years ago.
Absolutely, and they were considered, quite triumphant in the way they defended themselves. I think something has gone wrong there. I think partly it's structural in that they are in lower growth categories such as packaged foods. They're very exposed to the emerging markets. Nearly 60% of their business is there, and obviously those markets have been hard hit during the pandemic. You have largely unvaccinated populations there. Supply chain issues very hard hit by inflation. But I think they've also just been far too slow in recycling brands and streamlining their organization. If you look at rival Nestle, I mean, they have moved very quickly to get out of categories that are seen problematic from a regulatory point, such as ice cream, confectionery, and they're in much faster growth areas, coffee, pet food, and I think Unilever's just been too slow to do that. They've been trying to, but clearly not fast enough.
Okay, Deirdre, thank you. Bloomberg reporter Deirdre Hipwell on the changes at Unilever, a corporate story we will continue to follow after the news that they are going to be cutting some management roles. Thousands of management roles is what we've heard. Let's bring back Beata Monte, then head of European equity strategy at Citi. Beata, we won't ask you to comment specifically on this company, but more broadly, in terms of the consumer staples space in Europe, the changes that we've seen as a result of the pandemic, as Deirdre was highlighting for us there, and where it leaves things in terms of consolidation or M&A in this space. How are you looking at this particular sector?
So in terms of M&A, it remains one of our big themes that we've been running in Europe. However, we think that this year the spotlight is going to be stolen and moved from M&As to return of capital to shareholders, especially via buybacks. There's going to be a shift from higher dividends to buybacks in Europe. And Food and bev is one of the sectors that looks quite good on that factor. However, when I compare it to the broader market and other sectors within the European market, it ranks pretty badly. So what we want to capture is the environment of higher yields. This is where the sector doesn't perform very well. Its growth prospects in comparison to the other sectors don't look great either, and it's expensive. So it's an underweight for us.
Yeah. Beata, I have to say, overall, how Deirdre was explaining it in such plain words is that actually pet food sells, you know, some of the things that doesn't have supply chain issues sells, and that's where companies should be focused on, and then some of the regulatory concerns regarding ice cream and things like that because of the sugar content level is maybe something that you need to sell off or spin off. I mean, if you just look at how the pandemic has changed some of these consumer staples, is that how you choose the stocks that you want to be invested in?
So pressures on margins, or the winners from the margin pressures, this is what you've touched upon, is one of the factors we look at as well, definitely. And actually, when I talk to Citi stock analysts, they think that this is one of the sectors that could win on this front. So it's one of the very few sectors that our analysts think could actually defend its margins despite the inflationary pressures, or even put them higher. But as you mentioned, there are, you know, lots of idiosyncratic stories within the sector as well that will be pushing different stocks in different direction.
Beata, we can't talk about margins really in Europe without talking about energy prices, gas prices. Goldman Sachs coming out and saying you could be looking at a new record for nat gas prices if these tensions continue to escalate between Ukraine and Russia. Are you de-risking? Do you want to be de-risking as a result of the geopolitics?
So the way I look at, of course, geopolitics is very important, and we think the European gas crisis is one of the biggest risks in terms of geopolitics for the European and overall markets this year. But I would go back again to the higher real yield environment. So what higher yields do to markets is they make them more vulnerable to bad news. We had plenty of bad news last year. The yields were low and the markets were shrugging this bad news off, right? We think this year is going to be different, and the market is going to take more notice in terms of pricing of the bad news and geopolitics.
Beata, thank you so much. Beata Manthi, their head of European equity strategy at Citi. Now, coming up, Credit Suisse warning the embattled lender says fourth quarter profits will be hurt by about 500 million francs of litigation provisions. That's coming up next, and this is Bloomberg.
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Welcome back to the Open, everyone. We are 23 minutes into the European trading day. The picture actually looking up, but something that the market needs to be looking at a lot more is, of course, the fact that Joe Biden says he had a great 80-minute call with European leaders. That would mean that they could be a lot tougher on Russia and Ukraine, so we don't exactly know the development there. So I'm a little bit surprised that actually these markets still have a liftoff.
I mean, 8,500 troops is what Biden is looking on standby, US troops on standby, still on US soil, but on standby to go to Eastern Europe if indeed they feel that that is a need. We'll be getting more on that story, of course, throughout the hour. Let's get back to one of the big corporate stories. It is a big week for bank earnings, European bank earnings, after the US posted theirs last week. Credit Suisse says it expects to break even on a pre-tax income basis in the fourth quarter after a charge of about $550 million in litigation provisions. The lender was hit by the collapse, of course, of Archegos Capital and Greensill. That was last year, and a reboot under Chairman Antonio Horta Osorio was thrown into doubt after he was ousted for breaching quarantine rules. Let's bring in Bloomberg's Tom Metcalf for more then on the Credit Suisse saga. Tom, what is the latest news from this bank? Is it a surprise they've had to put aside 500 million Swiss francs for litigation?
Yeah, well, so it's another unwelcome surprise for this embattled bank. So as you say, 500 million Swiss francs. And I think they also said that the investment bank is going to post a loss this quarter. So, you know, it's doing very badly when you compare it to the US peers and also a cross-town rival like UBS. I think its shares are down 30% this year, and this kind of news will certainly not help.
Yeah, I feel like it's peanuts compared to what they've gone through. I mean, I know it's still 500 million Swiss francs, but it is Swiss francs, so, you know, it's not as much as if it were in dollars. And at the same time, look, I mean, they lost their chairman after 9 months in the job. They had trading scandals, like, you know, put that into context for us.
Well, I think that's the problem here. It's the cumulative impact. You're right. On its own, it's not going to sort of change the scene here, but it's just yet another issue they're facing. And there's no clarity on what this litigation charge is related to. No. So, you know, perhaps it is related to Archegos, Greensill, or perhaps there's other sort of smaller issues there that we don't know about. But no, you're right. It's much more the fact that, you know, investors into Credit Suisse have just gone from one thing to another.
Yeah.
Exactly.
Yeah, I guess a lot of people, the point is, when are they going to have a clean slate? When are they going to start afresh? When are they going to have a clear strategy? The earnings, I think we're expecting, what is it, February the 10th, when we're getting a full update. Do we have any sense of how things are expected to shape up?
So I think that will be the interesting point is, you know, they're taking a restructuring charge as well this quarter, and is this all part of an attempt to effectively, like you say, have a clean slate, you know, get all the sort of bad news out the way and then look at 2022 and perhaps with a sort of more positive angle, but you just never know with Credit Suisse at the moment.
Will they just be taken over? I know there's all these rumors that we've been covering, but is this like the most elegant way to just fix the problems?
I mean, so there's a lot of chatter about that. I mean, it's just market gossip at the moment, but you know, that is one obvious exit strategy full of problems, so I'm not sure it's the most likely, but certainly when you talk to bankers in the space in M&A, it's sort of the area they're most intrigued by.
Okay, Bloomberg's Tom Metcalf on the twists and turns. Continuing.
You know Tom is hitting the phones to get that story for us, if it happens.
Yeah. When the scoop comes through, it'll be on Tom and his team, no doubt. Okay, coming up, thank you, Tom. Russia-Ukraine tensions and Fed rate hikes. We look at the two biggest risks facing the markets. We'll break that down. We're going to be talking to Paul Donovan as well from UBS on the economics of all of this. Stay with us. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Roller coaster ride. The S&P 500 stages its biggest turnaround since 2008. European equities gain at the Open after their worst drop in 18 months. Eastern Europe on edge. The U.S. puts thousands of troops on alert amid diplomatic efforts to defuse the Russia-Ukraine crisis. And Italy's inconclusive vote. Lawmakers failed to elect a new president in the first round of voting in Parliament. Now, Tom, if you look at the markets, I mean, yesterday was really a pretty incredible session. We haven't seen that volatility in a one-day moving, trading session, I think for about 15 years or 20 years, you were saying. And we actually don't know what we're looking at today.
Yeah, since 2008 for the S&P 500, since 2001 for the Nasdaq. And of course, there was that buy the dip theme that came back, kind of rescue those markets. Yeah. But how much conviction is there, to your point, to sustain that? And certainly the gains that we saw at the beginning of the session here in Europe have paired somewhat after the losses that we saw, of course, heavy losses across the European sector yesterday. It was the geopolitics, it was what was happening in Russia, Ukraine, that fueled the sell-off in European equities yesterday. In the US, it was a mixture of that, it seems, but also that reconfiguration around the Fed and what it needs to do to contain inflation as we look ahead, of course, to the commentary from Jay Powell and co. on Wednesday. In terms of the benchmark then, you're seeing gains of 0.2%, but again, pairing some of the earlier strength that we saw at the start of the session. Gains of 0.1% for the DAX, up 20 points. The CAC Cajon is higher by 0.4%. We're still, of course, across these corporate stories of Unilever and Credit Suisse. We had strong earnings from the likes of Ericsson and Swatch, demand there from the likes of China and the US driving that company higher. The FTSE 100 are gaining 0.2%. The politics continues to be intriguing here in London as well. And Boris Johnson's future still remains uncertain. And then, of course, you have the Italian elections, the presidential elections, and the fate of Mario Draghi. France is up in April, by the way, with Macron. The telecoms are leading the pack in terms of these sector gains, up 1.6%. Ericsson will be part of that. Basic resources, oil is higher today, as is iron ore. That is part of the component for basic resources. Banks also gaining about 1%. At the bottom of the list, you have 5 or 6 sectors, including food and beverage, down 0.6%. So that is your sector look at 30 minutes past the hour. Fran.
Yeah, look at that, real estate, one of the biggest losers. But again, it's just down some 0.2%. So I'm surprised that the markets, it could all change. Of course, not more focused on this geopolitical tension. So these tensions, they continue along the Russia-Ukraine border. The U.S. putting as many as 8,500 troops on heightened alert for deployment to bolster NATO forces in Eastern Europe if needed. Now, Ukraine's ambassador to the EU told Bloomberg that leaders are united and there's a readiness to take possible measures.
There is a confirmation of unity of the European Union. There is a confirmation to help Ukraine to address this crisis. And also there is a readiness to take measures if necessary and to impose new sanctions, both individual and sectoral sanctions on Russia.
Well, joining us now is Bloomberg senior reporter for international affairs, Mark Champion, who's on the ground in Kiev. Mark, thank you for joining us. So President Biden has spoken with European leaders. He says the U.S. and Europe are completely united on Russia. First of all, is it the case? And is it a deterrent for Vladimir Putin?
Well, yes. First of all, it's not the case. They did a good job yesterday of trying to alleviate some of the damage that's been done in recent days when it was very clear they were not on the same page. When they were talking about different kinds of sanctions, there were a lot of different views about how to do that. So essentially what they did was to say, look, we just need to send out the message, as the Ukrainian ambassador there said, that we support Ukraine and that we will do something. The details are, where the devil is, and that has yet to be determined.
And Mark, the build-up of Russian forces on the Ukrainian border and indeed in Belarus continues. And we've had the US coming out, obviously, and making that move to remove some family members from the embassy there in Kiev. But then you have the Ukrainians calling for calm. What is happening with this disconnect? What does this tell us?
Yes, well, I mean, what it really tells us is that none of us really know what is in the mind of the Kremlin. But what it does is, in the US side, the UK also has been very tough, talking about, potential bloodbath, and they're really trying to to raise the level of alert and attention to get that kind of support on sanctions, to get the support on weapons and so on, to transfer to Ukraine. And these things are designed to deter Russia from doing, the worst that we would not want to see. On the other hand, for Ukraine, there are a lot of different options that they can see that the Kremlin has, and it's not at all clear that a full-out open invasion will be the one that's chosen. So short of that, there's a lot that can be done to damage Ukraine in terms of undermining the economy, undermining the political stability of the country, and those things. Once you start taking families out of embassies or removing embassy staff, that sends a signal to the economy, to investors, to companies and so on, that it's not a safe place to be. And so you're already, in a way, helping along potentially what the Kremlin is looking for, if that is the track they're on. And you're already giving them some of what they want. So for the Ukrainians, they're sort of trying to walk this very fine line where on the one hand, yes, we're under this supreme threat and therefore we need weapons. On the other hand, please, stay a little bit calm so that the economy doesn't take another hit.
Mark, thank you so much for joining us. Of course, live from Kiev, Bloomberg's Mark Champion. Now, investors, of course, also waiting the Fed's decision due tomorrow, expect to signal a March rate hike and announce the start of balance sheet reduction in July. Let's bring in Paul Donovan, Global Chief Economist at UBS. Paul, as always, thank you so much for joining us. There's a lot going on for markets and economists to digest this week with the Fed, that print actually from Australia, which smashed estimates. Are you expecting a surprise from the Fed in what language they use?
I don't think they're likely to surprise. I mean, we've got to remember, the Federal Reserve is not looking to squeeze inflation out of the economy. It's not looking to drive growth below trend because there's no necessity of doing that. Inflation this year is going to fall naturally. Growth this year is going to normalize naturally. I mean, basically, the Fed can sit there, do nothing, and pretend it's in control. So I don't think we're going to be seeing particularly aggressive language. I think the language needs to reassure the White House and Capitol Hill that the Fed is cognizant of inflation and that it's not ignoring it. But this is more about political spin than I think it is about economic action.
Paul, the yield curve flattening would suggest that there is concern amongst certainly bond market investors that you're going to get a drop-off in growth longer term in the US as a result of 4 hikes this year, 3 next year, or whatever the exact makeup is. Do you align with that view? Is that concern expected?
Well, we're going to get a drop-off in growth because last year's growth cannot possibly be sustained. It's absurd to suggest that we can carry on growing anything like this. We're coming back to a trend rate of growth. The yield curve is not a great predictor of economic growth. I mean, it sort of was back in the 70s when the inflation component of the yield curve was the dominant driver. But now the real yield is far more significant to the driver of long-term rates. And so it's not really a great indicator of where growth is going. What we're going to end up with this year, I think, is a very robust level of growth. And we may actually get some positive surprises relative to the economic models. Spending power is actually larger than consumer price inflation would suggest, and that's giving consumers an ability to sustain a higher level of demand than would normally be the case with these sort of headline CPI numbers. So I think that the overall growth story is going to be pretty good this year, and the Fed is not looking to derail that pretty good growth story.
So, Paul, when are you expecting supply chains to ease up a little bit? Supply chain constraints?
Well, I'm of the view that we don't really have supply chain constraints as such. What we had last year was the strongest demand surge for goods in the United States we have seen since 1946 and the ending of wartime rationing. So you have this overwhelming demand surge, and supply chains do a phenomenally good job of supplying goods into that overwhelming demand. But the demand is so overwhelming that you get these disruptions, you get delivery delays, you get shortages, which is what you would expect. But it's really important to focus on, is this supply chains lying in ruins around the global economy, or is this demand that is actually extremely strong? It's a key point, because if it's supply chains in ruins, that takes years to resolve. If it's just demand is exceptionally strong, well, you just have to wait until demand comes down. And we've already got evidence, in the States at least, that demand is coming back down to normal. We've seen that in retail sales. We've seen that in the fact that a lot of the stimulus checks and savings of the pandemic have been spent, at least for lower income households. So I think we're already moving to a point where supply and demand will come more into balance. I'd certainly be expecting to see a lot more signals of that over the next 6 months. Not because supply is somehow improving. Supply increased dramatically last year, but because we're normalizing demand. And this last 12 months has been a demand story. It's not been a supply constraint story.
So a recalibration, it sounds like you're a bit of a Goldilocks scenario in terms of demand versus supply. Does it, to what extent, can you quantify for us how much demand gets eroded by the adjustment of real wages, the depreciation of real wages?
Well, this is a complicated area because, of course, a lot of the wage data we're dealing with is rather old-fashioned, and we're not necessarily picking up on household income in quite the way that we would like to. So one of the stories since the pandemic has been this explosion of business startups in the US, in the UK, and in parts of Europe. And, of course, that income from the businesses is not necessarily being captured. You know, the TikTok creator who is selling baseball caps online, their income, their employment, in fact, is not appearing in the statistics. You know, the economist who is busy out selling books on labour markets and prejudice, yet that income is not necessarily appearing in average hourly earnings. So we're missing a bit on some of the income streams, and that's going to potentially be a problem. The other thing is to remember that consumer price inflation is not a cost of living measure. It doesn't measure people's cost of living. And a lot of people are experiencing a cost of living substantially lower than the headline CPI. So if you do not drive a car in the United States, and millions of Americans don't drive a car, your inflation rate is half the headline.
Thank you so much, Paul Donovan, Global Chief Economist at UBS. And of course, we'll stay with Paul and ask him a lot more about Italy and Europe. Coming up, Italy's presidential election enters a second round as lawmakers fail to elect a new president. The Prime Minister, Mario Draghi, remains the favorite. We have the latest from Rome next. This is Bloomberg.
would you like to achieve next in Saudi Arabia?
As you know, Barrick is invested in Saudi Arabia already in a partnership with Ma'aden, the state mining company. And we have an investment in the Jabal Sayed copper mine, one of the lowest cost, highest grade mines around, actually. And we have a real commitment to grow our footprint in Saudi Arabia with a particular focus on the Arabian Shield in partnership with Ma'aden. And so after tomorrow, I'm on the way to the mine. So not only how to be at the conference, but more importantly, to go and work with our team out at the mine who've really done a great job managing the COVID crisis over the last 2 years.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
Here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
Welcome back to the Open. We are 45 minutes into your European trading day. It's been a bit of a choppy session here in Europe. Company gains across the benchmark of 0.8%. Of course, investors weighing up the geopolitical risks around Ukraine with the Fed, of course, and any clarity that we may be getting from Jay Powell on Wednesday. Over in Asia, by the way, it was a bleak session, losses of more than 2% across the Chinese session. The CSI 300 near a bear market, and the topics falling over in Japan into correction territory. The future stateside point to losses of between 1 and 2%. In fact, the Nasdaq futures pointing to losses of, yes, almost 2% after that incredible session yesterday, whereby the dip saved the day, finally, after losses of more than 5% ended up in the green. That is the shape of play in terms of those markets in the future stateside, Fran.
Yeah, let's also turn to Italy, where lawmakers have failed to agree on a new president in the first round of voting. Now, it now enters a second round, but reaching a consensus in the country's divided parliament seems far off. Now, let's get all of the latest with our Rome Bureau Chief, Alessandro Speciale. Alessandro, so I don't know what we're expecting, because first of all, it's quite murky how presidents are decided. It could take 1 day, 2 days, even 3 or 4 days. Who's the runner-up?
So, yes, today we are expecting probably another session like yesterday. That is, most lawmakers will vote an empty ballot. Why? That's because parties are still talking to one another, trying to find a consensus. Mario Draghi, the prime minister, the former ECB chief, remains in the end the strongest candidate, probably, at least because all parties agree that he would be a good president. But parties want something from him. They want a stronger role in government, and they also want to show that they can matter. So they're still trying to find an agreement for someone from their own who can be a consensus president. And the president in Italy is a little more important than you would think, because it's a mostly ceremonial role, but he can form governments and he can dissolve parliament. So in crisis, he becomes quite crucial.
Okay, Alessandro Speciale on the presidential election continues. No clear outcome yet as they continue to negotiate. Thank you, out of our Rome Bureau. Let's get back to Paul Donovan of UBS, chief economist, of course, there. Paul, how are you thinking about the political risks in Italy? Obviously, there's a lack of clarity at this point as to what happens, the fate of Mario Draghi. When it comes to Italian BTPs, we saw a tick up in terms of yields on the spreads yesterday. Part of that was the Russia risk. Is there a consequential threat to the Italian economy as a result of this political risk?
I don't think there's a substantial threat, no. To put it politely, political instability is not unknown in Italy, and businesses and investors are perhaps used to a certain amount of noise in the political sphere. I think there is recognition that that Draghi would provide strong leadership for Italy, even in the more ceremonial presidential role. There is obviously a concern about what happens with the government between now and March 2023 and the elections. But I think that the general view is that Italy has had a little bit of a transformation over the last 12, 18 months, and the economy is on a somewhat firmer foundation.
But Paul, I mean, I know there's a transformation, and then there's a number of articles also suggesting that actually Mario Draghi wasn't so focused on the economy in the last couple of months because he wanted the presidency. What does it mean if Mario Draghi is no longer prime minister? What happens to Italian spreads? What happens to the reforms? What happens to the EU funds?
Well, I think the markets would obviously want to see reforms continuing, but the EU funding, I think, carries on. I think it's unlikely that that would be derailed. I think that the path of the Italian economy is more or less certain at this stage. The concern would be, I think, if there is a crisis in the government, if the government doesn't survive until March 23, and that would then raise questions about future policy direction. We'd be looking at a change in policy. But I think that the market at this stage would probably be looking for continuity with Draghi as president. I think perhaps a more interesting question is to what extent is Draghi as president able to influence European events in the way that he undoubtedly has played a role as prime minister. Being elevated to the presidency, does that diminish Draghi's European role, or is he still able to provide a key form of leadership in Europe at a time when perhaps other countries have not provided their traditional leadership roles?
Paul, what would a Russian invasion of Ukraine do to your forecasts for Eurozone growth?
That really depends on the reaction to that. Do we see sanctions so heavy that you are causing major disruption to energy supplies coming from Russia to Europe, for example? Do we see major disruption for a prolonged period to the oil price? A spike up in the oil price or a spike up in gas prices that lasts a month or even 3 months economically doesn't do a very great deal. But something more enduring, that leads to changed economic behavior, and that becomes a lot more significant. So there's a lot of uncertainty around not so much the act of a potential invasion, but the subsequent reaction to that. I think there's a couple of points worth mentioning, because there are some more extreme economic examples being thrown around. So the first thing to remember is that if you do see significant disruption, for example, to energy supplies, people will adapt, people react. This is the lesson of COVID. It's the lesson of every major cataclysm that we've had in the last 40, 50 years. People do adapt to that. You would see changed behavior, absolutely, but it would not perhaps be quite as negative as some of the more outlandish numbers that have been thrown around about impacts on growth. So yes, obviously this would be a negative. It would add uncertainty, but I think we would have to then start looking for how people find ways around that. People have demonstrated over the last 2 years that they can adapt in the face of adversity.
They certainly have. Paul, thank you so much. Paul Donovan, their global chief economist at UBS. Now, coming up, the UK Prime Minister Boris Johnson under fire once again, this time for allegedly hosting a birthday party, his birthday party, in Downing Street during the first lockdown. We have that story next. This is Bloomberg.
SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. Let's turn to UK politics now. Boris Johnson is shock horror under fire once again, this time for allegedly throwing a birthday party in Downing Street during the first lockdown. Joining us now is Bloomberg's David Merritt. David, on one level, these allegations are ridiculous and farcical. On another level, they're very serious, because this is when people were in lockdown, people were suffering, people were dying. Where does this leave the Prime Minister? What do we know about this latest, what is it, third party that Boris has been involved in?
Who's keeping track now?
Yeah.
I mean, I think actually the total amount they're talking about throughout this period, it's in well in double digits at this point, that apparently Sue Gray is looking at. But it's about the sort of the drip-feed nature of this, isn't it? Baroness Varsi, former chair of the Conservative Party, was on the BBC last night. She talked about this process of a death by 1,000 cuts, both to the reputation of the Prime Minister, but then more broadly, the reputation of the government and of the office of the Prime Minister. And, you know, there's serious things happening around the world. We have the threat of war in Eastern Europe. We have markets in turmoil as a result. And then all of this at home really does not add up to a great picture for this government.
So is the party still behind him?
Well, that
the million-dollar question.
That is the million-dollar question. Look, they're all, most of them are sitting on their hands until this key report comes out. Of course, some of the Prime Minister's supporters coming out very quickly last night. We had Nadine Dorries, the Culture Secretary, tweeting pretty much instantly after this report last night saying, well, you know, if you're in the office and someone gets a cake and you stand around and eat it for a couple of minutes, is that really a party? Maybe that's a clue to what the sort of defence is going to be when this report comes out, trying to spin it a little bit, say, look, this is not a big deal. This is stuff that was going on in an office that you would expect anyone to do. But of course, many of the public, and we know this from the polling, don't see it that way.
Very briefly, before we let you get to any time frame on the report.
Well, you know, it's anyone's guess at this point. Tomorrow, later in the week, that's what we're being briefed at the moment. But of course, you know, these things can change.
David, thank you so much. Or David Merritt, their head of EMEA News. Now, that's it for the European Market Open. Surveillance Early Edition is up next. We have a full roundup, of course, of the market moves after a pretty breathtaking spout of volatility yesterday in the U.S. close. We look also at geopolitics, Ukraine, and the presidential elections in Italy. This is Bloomberg.
Do you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be how quickly can we, all of us, execute to build capacity to meet that demand. And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
Big effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Today, we discussed Russia's continued military buildup in and around Ukraine. The risk of conflict remains real, and we continue to call on Russia to de-escalate and choose the path of diplomacy.
I had a very, very, very good meeting, total unanimity with all the European leaders.
The Federal Reserve has been behind the curve, slower to tighten monetary policy. And as a result, we're now starting to see the rise in interest rates to be able to deal with that.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. European stocks rebound after the S&P 500 stages its biggest turnaround since 2008. Wall Street looks set to open lower. Eastern Europe on edge. The U.S. puts thousands of troops on alert amid diplomatic efforts to defuse the Russia-Ukraine crisis. Plus, Credit Suisse warning the embattled lender says fourth quarter profit will be hurt by about 500 million Swiss francs of litigation provisions. Now, first thing is first, let's check in on the markets, and then we have a deep dive into a lot of these big stories that we have been watching. Now, yesterday was a pretty breathtaking session. Certainly, volatility, it was back with a vengeance. The stocks in the U.S. down around 4%. And then at the last minute, we had a lot of dip buying, and they actually ended up in the green. European stocks today getting a lift off 0.5% higher. The focus, of course, on the Fed. We did have also Australian inflation smashing estimates. That could be repricing some of the expectations that some traders have on Fed tomorrow. Interesting to see, again, the dichotomy. European stocks may be doing a bit of catch-up, certainly with some of the tech that we saw yesterday, and S&P futures actually on the lower side. The U.S. 10-year yield at 1.789, and then dollar ruble, the one to watch out for in terms also of Russian ETFs, where we saw huge outflows because of what could happen in Ukraine, currently at 78.67. Now, we also had that Germany January IFO business confidence coming in a touch better than expected, 95.7. The estimate was 94.5 because of the focus on energy price, because of what's happening in the geopolitics with, for example, the U.S. saying they have 8,500 troops on alert to send to Eastern Europe. It's interesting to see that actually IFO confidence was a bit better than expected despite those rising energy prices. For the moment, you can see the DAX, the FTSE MIB, where there is the presidential election ongoing, and here the FTSE gaining some 0.4%. Now, we're also joined to talk about the markets, treasuries, the Fed, and everything in between by Scott Thiel. He's a chief fixed income strategist at BlackRock. Scott, thank you for joining us. I mean, there is so much to talk about. Let's start with the volatility. Is it the different type of investor that was selling and buying yesterday? Is that how you explain it? Or is volatility back?
Well, I think it's both. I think both its volatility is back, as there are obviously concerns about policy and also about political tension. But also, Francine, one of the things we have seen is that in the selling, as we look through our kind of our franchise, we see both retail and institutional selling. So I think both sides of the of the party here have been involved, both the retail and the institutional side.
So, Scott, what does it mean for actually how much flatter the yield curve will go?
Well, I mean, I think, we're going to get some information on Wednesday about monetary policy going forward. And one of the things that we've noted is that although the sum total, I think this is very important, the sum total of rate hikes over the cycle remains around the same as it did prior to Christmas, the pathway is very different, right? And so what we have seen is that the market is now expecting, much more monetary policy tightening in this year and next year than it had previously. At the same time, we're also going to get information about the QE unwind and potentially about the runoff. That will also be very important. So on balance, we would say that rates are going to move higher over the course of the year and the yield curve will steepen. But in the near term, we see some stability, which is why we've taken back some of our underweight to treasuries this week in our weekly view. But the idea would be that policy is going to be obviously very important in terms of yield curve direction. We should get some information about that on Wednesday.
So, Scott, at this moment, I know we had an inflation print that actually smashed estimates in Australia. Does it make you change your view on what could happen to inflation in the U.S., or are we still separate, quite separate in terms of various regions?
I think the regional differences are really important right here, Francine. And I think one of the things that we have highlighted over and over again here, and this is mission critical for understanding markets, performance, equities, and fixed income, is the supply constraint nature of inflation, right? And that is a very important thing to keep in the frame as you try and evaluate, your market views, right? This is not kind of a normal business cycle, not a normal inflationary environment driven by an economy overheating. This is about supply constraints, whether it's COVID related, whether it's the transition to net zero, and whether it's geopolitics, right? So it's a very different environment.
Scott, where do you see the most value then in fixed income? I don't know whether we'll talk about Europe and Italy in just a second, but regionally, where does it look more attractive?
Well, we do like emerging market local bonds as an overweight for us. We note that the rate increases there have been substantial. Yield is much higher on the index. The currencies have been under pressure. And as we look going forward and we see the balance, of policy shift, we do like emerging market local bonds. And again, noting both from the rate perspective, because we've seen increases already and further are priced in emerging markets, and because of the underperformance of the currencies. Again, inflation protected bonds with U.S. break-evens around 2.5%, slightly lower. We still think that is an attractive asset to own, particularly because we think longer-term inflation is closer to 3%.
Scott, thank you so much. We'll have plenty more, of course, from Scott throughout the day. Scott Theo, their chief fixed income strategist at BlackRock. Now, coming up, high alert, the U.S. gets troops ready for deployment as NATO shores up defenses in Eastern Europe. We get the latest live from Kiev later on in the program. This is Bloomberg.
Mentioned the 1.5 million tests. That's quite a feat. At the same time, I've seen estimates say that'll get you through about a week or so. What do you do after that?
Let's be smart with our resources. Why not use the test strategically when you need them? How are we using them? A child is diagnosed with COVID in a classroom. We give that entire classroom take-home test kits so their parents can test them, so we can determine if we should close down the school or just the classroom, or what we should do with that particular facility area. what has happened in the past, you had one diagnosis, we want to close the entire school. That just makes no sense. Instead of using our resources in a strategic fashion, the science has shown just because one child has COVID in the classroom, it doesn't mean the entire school or the classroom is infected. We're going to be smarter and we're going to pivot, and most importantly, we're going to defeat COVID.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get back to the markets. And joining us with the very latest is our Danny Berger. Danny, we were just talking about volatility, and you have some great charts to illustrate it.
Yeah, I definitely do. When we look at yesterday, one of the questions has to be, what does this turnaround mean for markets? Does it mean that there is more concern bubbling under the surface? And I've come prepared with stats that unfortunately do suggest so. So yesterday, we saw the sell-off of nearly 5% intraday for the Nasdaq 100. It ends in the green. Now, this isn't unusual. It's happened 11 times before in the past, but the times that it's happened before are not exactly comforting. 3 times in 2008 and 11 times during the dot-com bubble. So not great historical corollaries there. But more than anything, one of the instruments that really showed angst coming through was the ETF that tracks this index. That's, of course, the triple Qs from State Street. Now, this ETF, if I can use a technical term, the trading on it was absolutely bananas yesterday. So we saw volume on this thing hit the highest level ever. More than $68 billion worth of this ETF was traded yesterday. That's more than $25 billion past the prior record. And not only that, options underneath the surface, that also hit a record, and that was led by put options. Now, usually when there's angst in the market, it will show through on ETFs because this is a very liquid instrument. It's easy to trade in and out of. So, Francine, this gives us a really good sense of how investors are feeling about this market and how they're fleeing to protection and trading a whole lot.
I love that, Danny. It's bananas. This is like the real technical CFA level 25 that we need in our lives. Danny Berger, there were some really great charts. Scott, what's most bananas when you looked at the fixed income and you specifically look at Europe? I don't know whether it's, you know, the correlation between Italy and Germany. I know the ECB is staying pat, but at some point it will change, or whether it's the pricing of gilts.
I mean, I think, you know, in Europe, one of the things we've noted, obviously, is that, you know, BTP spreads have widened. We were talking about Italian elections earlier in the program. You know, part of that, I think, is Italian politics, and part of it, which obviously is a very complex situation, and part of it also is that, you know, as market participants look at the unwind of the QE program in the U.S. and the decreased purchases by the ECB, they can't help but, you know, kind of make some assumptions about the two markets. And one of the things we have noted is that European government bonds have performed very poorly here, with really not the same dynamics, right, at the ECB as we're going through at the Federal Reserve here. And so I do think it speaks to the, you know, the global nature of fixed income, but it also speaks to kind of, you know, investors are concerned about what's happening in Europe as well as the U.S. And one of the things I would note, it's interesting, Danny's comment about the increased volatility. One of the very big differences between fixed income and equity markets is that in huge amounts of volatility, equity volume goes way up and fixed income markets go way down. And it's an important difference. And so I do think trading volume is an interesting indicator of volatility.
Scott, what happens when the ECB stops buying some of the bonds?
Well, I mean, they've projected a decrease in the amount of purchases, but very importantly, right, they remain a purchaser through time, and they've made that very clear. And so it's not the same, you know, same dynamic. Obviously, the ECB's position in the market is very pervasive, right? And the amount of bonds that they own across all the different countries, in Italy in particular. And so market participants, I would argue, are more focused in some respects on the purchase program and how that goes forward. and are pricing Italian spreads with that more than they are, I think, with Italian politics. But I do think, Francine, it's a very important, the supply-demand dynamics in Europe are mission critical, and the ECB, again, has told us that they're going to decrease the amount of purchases, but remain a buyer through time.
When you look, Scott, at some of the things that, in terms of repricing, if Mario Draghi leaves the Italian government to become president, and, we have no clue or no insider knowledge at the moment whether that will happen, but he is still the front runner, what happens to the spread?
Well, it's interesting. We think in the scenarios that we've played out, that may be our most likely scenario where he becomes president. And in some respects, actually, we think that may be positive, particularly if it's with a high majority, because what that might allow is a centralization of some of the fringe parties to continue, Francine. I think that's a very important underlying theme here. And so, again, we would look for, we haven't had a particular view on Italian politics because of the uncertainty of Italian spreads, because of the uncertainty of politics and the ECB. But when we look at it, it starts to look attractive to us at these levels. Again, I do caution, I think that the QE program and perceptions around the ECB are as important as Italian politics for the overall level of the spread.
Scott, I don't know what you do with UK assets right now. I know there's like Partygate, but at the same time, there's also talk about raising taxes in April and what that means for a fixed income buyer.
Yeah, and I also think, so gilts, gilts have taken their cue from treasuries in some respects, and also from the Bank of England. But I think also the important thing here, right, is that the gilt holdings by the bank are also going to obviously be under scrutiny as rates increase. As you know, they have a QE program or QT program that is tied to the level of interest rates. And so as the bank tightens, we'll see that portfolio shift. So I do think there is pressure on UK rates as there are in other major, risk-free rate markets. And in particular, the Bank of England is active as the Fed will be shortly. And so I think the same dynamics exist there, Francine. In other words, focus on policy, a focus on the bank's holdings as rates increase, given their kind of rule-based approach.
Scott, we haven't even really touched on what's happening in China with some of the fixed income space and even, renminbi. How do you trade or how do you look at China in the next 12 months?
Well, we're positive China both in equities and in fixed income, and it's primarily based on this idea that we would see a policy response to the slowdown in economic activity that was a result in part of the kind of later nature of the far forward nature of the COVID and also the clampdown issues. What we've seen here, obviously, is that China's taken a very different approach to COVID in terms of their dealing with it and the outbreaks. But we would, again, still say that the policy, we're starting to see that, right? Easing in monetary policy, easing in regulatory policy as a positive for both Chinese bonds, which we are overweight, and Chinese equities that we're overweight. Still positive on China. Note dramatic, because of volatility in U.S. stocks, but dramatic outperformance of Chinese index in the first couple of weeks of this year.
Scott, thank you so much. Scott Thiel, their chief fixed income strategist at BlackRock, joining us this morning. Now, coming up, Germany's IFO Business Confidence Index rose in January. Economists were expecting a fall, and we speak to the Institute's president, Clemens Fuest. We also talk about energy prices and Russia. That interview is up shortly. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Germany's IFO Business Confidence Index rose in January. Economists were actually expecting a fall. We're joined to talk about this by the IFO Institute President, Clemens Fuß. Mr. Fuß, thank you so much, as always, for giving us commentary surrounding the IFO number. Were you surprised, but actually the strength of the economy? And is it surprising given the energy prices and that volatility we've seen over the last couple of months?
Yes, maybe it's surprising. What we see in the data is that businesses are telling us the current situation isn't really great. So it's even a little worse than in December. But for the coming months, companies are expecting an improvement. And that's what's driving the IFO index in this case.
So, Mr. Fuß, how do you expect actually the economy to operate in the coming months and quarters?
I would expect the economy to be subdued in the first quarter, and this is related, of course, to the Omicron wave, to continuing supply chain disruptions. But I would expect an improvement in the summer when the Omicron wave will hopefully have been overcome, and linked to that when supply chain problems are easing. So the expectation is we will have a good summer. Households have a lot of savings they would like to spend, so there is potential for a stronger recovery in the summer.
So how do you expect the energy prices and actually this ongoing tension with Russia to play into, people's thinking and confidence for their future?
That's certainly a big unknown. So what we would expect without changes in the Russian-Ukraine situation would be energy prices to remain high but not to increase further. Of course, if there is a conflict, if there is an armed conflict in Ukraine, there may be spikes in gas prices, and that may certainly disrupt the economy more, and it's very hard to predict how that plays out. So our scenario currently is that there will not be an armed conflict, and energy prices, yes, they will remain high, but not increase further.
I mean, we had, Australian inflation data that smashed expectations. Are you expecting any inflation shocks?
We do see in the data that a lot of companies intend to increase prices, so price pressure will remain strong. At the same time, we have these base effects. For instance, the VAT cut, which was phased out at the beginning of last year, and this will bring down inflation readings. So overall, we expect high inflation rates in the first months in Germany and the Eurozone, but then we expect these inflation rates to gradually go down. Of course, this depends on a lot of factors, one being energy prices not skyrocketing, the other being that other import prices like foods, commodity prices, not increasing significantly. So there's a lot of uncertainty in there, but due to the base effects, there will be a tendency of inflation rates to be coming down. So I wouldn't expect an inflation shocks. Also, demand will go back, be channeled more to services once the Omicron wave is overcome, and that will also contribute to the easing of inflation in the Eurozone. Here, the situation is a little different from the US, where inflationary pressures are certainly strong.
But Mr. Fuster, if you have, an inflation ticking higher, is this because of supply chain constraints, or do you think it's actually demand? Is it the healthier kind of inflation that could be coming through?
In Europe, it's unfortunately the less healthy kind of inflation. It's coming more from the supply chain problems. If we compare demand for goods in the US and the Eurozone, it's weaker in the Eurozone. It is there, but it is not as booming. So it's not the factor driving inflation in Europe as it is in the US.
What do you see, Mr. Fuster, the right, policy mix? I don't know whether the fact that we're looking at a presidential election in Italy and we're also looking at the French presidential election over in April could, significantly change the composition of the Eurozone and therefore impact Germany.
I think the expectation is Macron in the end will win the presidential election. In Italy, there's more uncertainty, but not the expectation that these elections will create major problems. That's why I would expect no significant impact from that side. Overall, in terms of policy, I think the ECB should slowly continue phasing out bond purchases. It's probably too early for interest rate increases, but of course it needs to watch the inflation rate.
Wonderful. Thank you so much for all of your insight. The IFO Institute President there, Clemens Fuster, joining us this morning. Now, coming up, Credit Suisse closes out a year marred by scandals and turmoil at the top. We'll have plenty more on that story. That's coming up next, and this is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Bloomberg has enhanced search on the terminal.
to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
European stocks rebound after the S&P 500 stages its biggest turnaround since 2008. Wall Street looks set to open lower. Eastern Europe on edge. The U.S. puts thousands of troops on alert amid diplomatic efforts to defuse the Russia-Ukraine crisis. Plus, Credit Suisse warning the embattled lender says fourth quarter profits will be hurt by about 500 million Swiss francs of litigation provisions. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, first, let's check on the markets. Wow, what a volatile day we had yesterday. It was really breathtakingly volatile. At certain points, we saw, according to JP Morgan, actually a sell-off from retail investors at around noon. And then, actually, buying the dip mentality came in and supported a lot of the U.S. stocks. That's filtering through to European stocks today. But then the S&P futures are down some 0.8%. On to corporate story number one. Credit Suisse saying it will set aside 500 million Swiss francs for litigation in the fourth quarter. Now, the bank also warned of outflows in its key wealth business as clients pull back, particularly in Asia. Now, the charges cap a year that has seen Credit Suisse reel from the collapse of both Archegos and Greensill, as well as the ousting of their previous chairman for breaching quarantine rules. Now, let's bring in Bloomberg's European banking reporter, Tom Metcalf, for the very latest. First of all, Tom, I have to correct also myself because I was quite clumsy the last time you came on. So 500 Swiss francs is about $525 million, which is nothing to be snobbed about. This is still a big number.
Yeah, no, exactly. I mean, look, it's more bad news for Credit Suisse. It's perhaps not at the same scale as an Archegos, as a Greensill, but investors in the lender must just be wondering, will they catch a break? The whole year, you've seen AHO leave. It's just been a series of bad news.
Yeah, and I feel like we've been saying this for a couple of years. Will they ever catch a break? I mean, what do they need to do? First of all, we don't really know what this is related to. So could it be the end of something that was bad news, or could it be the beginning of something?
Yeah, exactly. I mean, that's the hope. It's Q4 earnings, so they're taking a big restructuring charge beyond this 500 million. I think it's 1.6 billion for restructuring. So, supporters or optimists might say, you know what, the slate is swiped clean, 2022, here we come. But, this is banking, and you tend to get surprised by things as each quarter comes.
So how do they get out of this? And again, what needs to happen for them to have a clean slate?
Well, I mean, pretty drastic shift right at the top with the chairman move in. And I think what they just need is some stability, right? Kind of just a couple of very boring quarters, focus on the sort of nuts and bolts of the business. That will sort of help restore a bit of confidence, I'm sure. And then, you have these bigger picture ideas. Does Credit Suisse, look to M&A, or does it sort of look to maybe farm off some smaller assets?
Does it make sense? And would the regulator even say yes to it?
I mean, that's the tricky thing, especially with all cross-border M&A, but particularly Switzerland. Would they really want Credit Suisse to sort of team up either with a Swiss bank or an overseas bank? Big questions over that.
Big questions, but I know our Tom Metcalf and, of course, all of his team will be across it. Tom, thank you so much, in charge of our UK banking team. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Here in the UK, Boris Johnson is facing further allegations of holding parties during the pandemic. ITV reports up to 30 guests attended a Downing Street birthday celebration for Johnson during the first lockdown in 2020, when most indoor gatherings were banned. Johnson's office says staff gathered, but the Prime Minister was present for less than 10 minutes. Now, German Chancellor Olaf Scholz is holding firm on a refusal to supply weapons to Ukraine, despite criticism that the stance undermines efforts to deter a Russian invasion. Scholz said Germany will stick to its long-standing exporting weapons to conflict zones, adding that Berlin is prepared to support Ukraine in other ways, including training. And Rio Tinto has struck a deal with Mongolia to start work on a long-delayed copper mine in the south of the country. The agreement sees the cancellation of almost $2.5 billion of debt owed by the Mongolian government for its share of construction costs. Production from the $6.9 billion mine is expected to start next year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, the first round of Italy's presidential election saw no winner as an agreement in the country's divided parliament remains far off. Now, voting is set to resume today with the current Prime Minister, Mario Draghi, seen as favorite to be picked as the new head of state. Now, we're joined by Carlo Cottarelli, director of the Observatory on Italian Public Accounts at Università Cattolica. In 2018, Carlo served as Prime Minister of Italy for a short period, having been appointed by the President Sergio Mattarella. He's also former director of the IMF. So thank you so much, Carlo, for joining us. First of all, how long will the process take? I know it could take, anything between like 2 days, 3 days. Are we any closer to having a candidate that would be supported by enough parties?
We don't know how long it's going to take. I'm relatively optimistic that a solution, an agreement can be found in a matter of few days. The first 3 votes require a majority of 2/3, and I don't think it's going to happen. Today is the second vote, but by the day after tomorrow, only a 50% majority, 51%, 50 plus 1, will be sufficient. And I think an agreement is going to be reached relatively soon. That's my expectation.
Yeah.
But we have to see. It's still very uncertain.
So what happens, and I guess this is what the market is most worried about, that Mario Draghi, the current prime minister, which has brought a lot of stability, which to the markets and the international finance community will be picked to become president of Italy, therefore leaving a void, of course, as a head of state. What does it mean if Mr. Draghi becomes president?
It depends on whether the appointment of Mr. Draghi as president also comes with an agreement on what happens to Palazzo Chigi, so the prime minister's office. What happens to the prime minister? Who will be the new prime minister? The two things will have to be, in my view, agreed together. But the shape of the agreement for if Draghi becomes president of the Republic, the shape of the agreement will be very important, because if there is an agreement that is clearly not going to last, there may be a negative market reaction. I don't expect, however, that there will be an immediate market reaction. It's going to take a while for markets to look at what is happening, what will happen. The interest rate spread has already increased in the last few months. It's about, yesterday was 140 basis points. I don't expect a dramatic market response. But over time, if the government that follows Draghi's government, if Draghi goes, is a government that is weak, then there will be a market reaction.
But how do you see this playing out exactly? So, if Mr. Draghi becomes president, are the EU funds at risk? Are the reforms at risk? Or would an agreement on who would become prime minister automatically try and put some stability in place?
No, the worst scenario would be to have, worst scenario, at least in the short run, would be to have a government that is unstable, and therefore after a few months it has to resign, and that we go to general elections pretty soon. That, of course, will probably stop the reform process for the year. And then it depends on the outcome of the election. The most, in a way, reassuring form of government would be what has been proposed, for example, by Mr. Salvini, the leader's government. Draghi becomes prime minister, and then there is a government where the heads of parties put their own face directly, which is probably, in my view, the only solution to have a government that lasts until the spring of 2023, when there would have to be, in any case, general elections.
So do you think, but what is the likelihood actually of these general elections this year in 2022? Is it a 50% chance?
No, it's probably less than 50%. But the risk is also that you have a government that is weak, and does not carry forward the reforms as strongly as needed. 2022 is a very important year in terms of reforms because many of the laws, the reforms that were implemented last year were simply, I hope the term is exact, enabling laws, laws in which the parliament would ask the government to write the decrees that are needed to make the changes in the legislation. Those decrees will have to be written this year. And here I'm talking about the reform of justice, the reform of the fiscal system, some aspects of the reforms of the bureaucracy, and so on and so forth. There is a lot of stuff that has to come this year. And on top of this, the European fiscal rules will have to be renegotiated this year. So it's very important who leads the discussions for Italy.
Yeah, so what is at risk? And I know for an international, especially finance audience, there's so many groups that it's very difficult to see what kind of name could emerge. Do you have a hunch of who could replace Mario Draghi if he becomes president?
No, that's very uncertain. There are some names that are circulating. The main choice is between somebody from the technical side, let's say, who is already in government. It could be the finance minister, Daniele Franco. It could be the justice minister, Marta Cartabia. The other solution would be to have some politicians. But in my view, is that if there is an interim government, if there is a government that is not led by Draghi, probably because it is a coalition government, they will have to find somebody who is relatively neutral, and therefore could be a more technical person.
All right, Carlo Cottarelli, thank you so much, Director of the Observatory on Italian Public Accounts at Università Cattolica. Now, coming up, President Biden declares total unity in the West after crisis talks with the EU leaders on Ukraine. We look at the Ukrainian situation, we look at the market action, of course, huge moves in Russian ETFs. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
There is a confirmation of unity of the European Union. There is a confirmation to help Ukraine to address this crisis. And also there is a readiness to take measures if necessary and to impose new sanctions both individual and sectoral sanctions on Russia.
Well, that was the Ukrainian ambassador to the EU in a united response on Russia-Ukraine tensions. President Biden, meanwhile, has declared that the U.S. is aligned with its allies, placing 8,500 U.S. troops on heightened alert for deployment to Eastern Europe, where they would join existing NATO forces. Russia continues to deny plans to carry out a fresh offensive in Ukraine. Now, with us to discuss all of this is Bloomberg senior reporter for international affairs, Mark Champion, who is in Kiev. Mark, first of all, good morning. President Biden says there's total unity from the West. Germany, though, refusing to send weapons to Ukraine. So it doesn't look like a very unified Europe to me.
No, and the call yesterday was really to, fix some of the damage that was done in recent days as they argued about, what kind of sanctions to levy on Russia. The US and the EU face very different consequences from those. And then again, of course, about what weapons to send and whether to send lethal weapons, Germany being a bit of an outlier in that, but not alone. So, yes, they are not unified, but it was important to have that call just to make clear what they do agree on, which is that they support Ukraine and that there will be some kind of response if President Putin decides to attack.
Mark, I mean, I guess one of the questions that we've been trying to figure out is what is Vladimir Putin's endgame? So is he trying to break up allies so that he's, he rules by division amongst, for example, the US and Europe, or even within Europe, France and Germany? Or is it actually to take over parts of Ukraine?
The correct answer to that is that we don't know, and quite possibly all of the above. So I think the way that one has to look at this is that, President Putin's the goal that we know he has is to put as many options on the table as possible, to keep everybody guessing as to which of those options he plans to use, to leave himself in the driving seat in deciding the agenda and the pace at which things move. And so far, he's been very successful in doing that. It's a difficult, scenario for the rest of the world to respond to because they really don't know what his preference is. And it's quite possible that he has not himself made up his mind as to what he will finally do.
Mark, I could have a conversation with you for about, 10 hours because I have so many questions. What's it like, first of all, being, on the ground in Kiev? So you look at the news and I imagine everyone's talking about nothing else than a possible Russian invasion, but are people going about their daily lives?
No, absolutely. People go about their daily lives in Kiev, and that strangely, because I came all the way across from the east, I drove from the east where the front line is, and then all the way across to Odessa, and then up to Kiev. And quite frankly, the further you get away from the front line, the less calm it is. And, there's fighting at the front line. It's been going on for 8 years, but generally people are just going, they go to restaurants, they talk, they're making business plans, they're investing, they're doing all these kinds of things as though there was no threat. Of course, they know there is a threat. They just simply, I think, have decided that they cannot guess what's going to happen. So they simply have to make a decision. Do you pack up and leave? You close your business, you go away because you're afraid something might happen? Or do you just carry on and prepare as best you can? And largely they've chosen the latter.
Yeah, and I guess, Mark, it's a very difficult, decision situation because you also don't know exactly what Vladimir Putin could do, right? If it's an invasion or maybe stopping at the border or just over the border. Mark, overall, when you look at the timeline of this, is Vladimir Putin, playing for time and dragging this out also to destabilize his opponents?
I do not think so. I think that everything that they've done at the moment is to create urgency, to bring the timeline for diplomacy forward. I mean, the kinds of things that they're asking for from the US and NATO are, very, very difficult, if they're not impossible, to achieve. And if they were to be truly negotiated, it would take years, frankly. So he's been pushing the agenda, forward. In order to, he wants this to be done in a matter of months, which is fast when you think about the kinds of things he's talking about, changing the security architecture in Europe, creating a sphere of influence, essentially, for Russia, making sure that, Ukraine can't join NATO, can't join the EU. These are very big changes in, the landscape in Europe. And he's made a very short time frame for them, I think.
Mark, thank you so much. Our Bloomberg senior reporter, of course, for international affairs, Mark Champion in Kiev, Ukraine for us. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Unilever is to cut 1,500 management positions to speed up decision-making. The move comes after activist investor Nelson Peltz built a stake in the London-based consumer goods giant. CEO Alan Jope is under pressure after a failed bid for GlaxoSmithKline's consumer healthcare unit. The company is also making ice cream an independent unit as it recognizes its business into 5 groups. And IBM has posted its strongest sales growth in 10 years thanks to growing cloud demand. Sales surged by 6.5% in the latest quarter, beating analyst estimates. IBM's hybrid cloud sales jumped 16% in the latest sign the tech giant's pivot to newer technologies is indeed bearing fruit. Credit Suisse is capping a year marked by scandals and turmoil at the top. The Swiss bank will book more charges for legal matters in the fourth quarter, plus it warns of outflows in its key wealth business. Credit Suisse has been reeling from the collapse of Archegos Capital Management and Greensill Capital, and Chair Antonio Horta Rosario was ousted after 9 months after breaching quarantine rules. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, coming up, Boris Johnson under fire yet again. The scandal that just won't go away has a birthday twist. We have that story next. This is Bloomberg.
EVs coming to market. And I'm wondering, do you think that just the market share explodes and there's room for everybody? Or is there a specific market that you're going after right now?
At Vingroup and VinFast is the same way. We're building premium quality products for mass market. And we do expect that there's an irreversible trend to move from internal combustion engine vehicles to electric vehicles. So yes, the market share would expand.
How much money do you think you're going to have to sort of pump into everything right now? You also mentioned, this is an announcement from last year, that you're going to start a factory here in the U.S. Where are you in that? What kind of money are you looking to have to deploy?
So far, VinFast has put in about $6 billion so far into VinFast. And we plan to have a few more $1 billion investment.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's turn to the UK and UK politics. Boris Johnson under fire yet again, this time for attending his own surprise birthday party held in Downing Street during the first lockdown. The fate of the Prime Minister will be in focus this week when a report into rule-breaking parties at Number 10 is published. Now joining us now is Bloomberg's David Merritt. David, it's very easy to actually laugh about all of them and saying, right, well, when did they not have a party at this point? Because there were just so many that you almost can't keep track of them. But with every revelation, will he have to resign? Will he be pushed out? How can the Prime Minister survive this?
Well, it does feel like every day there's a new revelation, isn't there? Another party. We're well into double digits here of the amount of these things that have now been clocked up. Downing Street not even denying this one, saying, yes, it did happen, but trying to downplay the significance of it, or that it was really a sort of party, and many of his allies saying the same thing. But, you know, I listened a lot of interest to Baroness Varsi. She's been the chairperson of the Tory party. She was on the BBC last night. She said, look, this is like the death of a thousand cuts. You know, it's undermining, every one of these revelations undermines further our image of him, but also more broadly about the office of the Prime Minister and Britain's standing around the world. And yes, it's a laughing matter, but when you listen to the stories of the people who were unable to attend dying relatives who were denied from all these life events, they don't find it funny at all. And that's what's so damaging about this, is that some of these stories are really horrific, what everyone went through this time of year. And time and again, we keep learning that the Prime Minister wasn't following those rules.
Yeah, and what's incredible, at least for me as a foreigner, is that this is the UK. I mean, the UK, which in the past has always held itself to the highest standard. So what are the Tories, you know, thinking about this? Is his party still sticking by him?
It's remarkable, isn't it, that actually many other prime ministers, you would assume, with only a fraction of these sort of revelations, would have probably have stepped down at this point. And look at the corporate world, Credit Suisse ejecting their chairman pretty rapidly with just a smaller infringement of the rules. This Prime Minister's made it very clear he's not going anywhere unless he's forced out. And, you know, it's going to be up to his MPs to actually do that this week. Do they have the numbers? You know, that is the big unknown at the moment.
But Dave, why do they still support him? I mean, is this man so charismatic that actually they can't win the next re-election? Is he so charismatic that no one else can replace him?
Well, just cast your mind back just a little bit over 2 years ago. An 80-seat majority this man delivered, the biggest Conservative win since the heyday of Margaret Thatcher, persuading people across the whole country to vote Conservative who had never voted Conservative in their lives. And of course, MPs are remembering that, thinking, well, who else in the current MP, in the current intake, can stitch together that sort of coalition and win again? And, you know, they're going to be asking themselves whether they've got any better alternative than this Prime Minister at this point.
So we'll see. I mean, can we call it? Will he survive it or not?
I think, you know, that is the million-dollar question. I think his position is looking very, very difficult indeed, but we're going to have to wait for this report this week.
Yeah, we certainly will. Everyone waiting for that Sue Gray report. Thank you so much, our head of EMEA News, David Merritt. In the meantime, markets, if you look at futures in the U.S., they are a little bit actually subdued, but here in Europe, we're still seeing gains. We'll have plenty more on that with Matt Miller and Katie Lyons in New York and Edwards here in London. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Tuesday, January 25th. Our top stories today. Stocks are mixed and U.S. futures are lower after that dramatic reversal put U.S. benchmarks back in the green. Investors still concerned, though, about higher interest rates and geopolitical tensions. Show of force. The U.S. is set to deploy 8,500 troops to Eastern Europe if needed. Meanwhile, the U.S. and Western Europe are still giving diplomacy a chance. Leaders discuss their options on Russia and Ukraine. And a bad year at Credit Suisse just gets worse. The Swiss bank will book more charges for legal matters in the fourth quarter, and it warns of outflows in its key wealth business. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, in case we were under any doubt this January, volatility in stocks certainly is back.
Volatility back in a big way. Yesterday was an insane day, Anna. You saw losses of about 4% or more on U.S. benchmarks, actually ending the day in positive territory. A remarkable rebound that didn't really continue in Asia overnight. Instead, Asian stocks were broadly lower. The MSCI Asia Pacific Index down about 1.5%, and you have several benchmarks approaching very key levels. The Topix in Japan, for example, down 1.7% overnight. It is now in a technical correction, down more than 10% from its peak. And when it comes to the CSI 300 in China, it is now down 19.5% from its record high last February. So we are very, very close to bear market territory as it posted a loss of about 2.25% overnight. Of course, there are still a lot of strategists positive on the China story, given the easing coming from the PBOC, but a lot of central banks aren't going in the easier direction. They're going in the tighter direction, and that is true, too, in Singapore, where the central bank reacted to the highest inflation in 8 years with a surprise tightening move, and as a result, the Singapore dollar, the big outperformer in Asian FX, stronger against the U.S. dollar by about 0.2% to 134.39. And then, of course, speaking of inflation, it came in hot in Australia. That is refueling bets on an earlier hike out of the RBA, and as a result, you really saw a reaction in the short end of the curve in Australia, that two-year yield of about 6 basis points overnight, Matt.
All right, it was
definitely insane, Kaylee. I concur. And I think all eyes really are on the S&P. This is the kind of broad, stable benchmark that isn't supposed to make a 4 or 5% round trip in the span of just a few hours. Right now, we see futures down after the big bout of volatility yesterday. The U.S. 10-year yield up a little bit as investors feel comfortable enough, it looks like, maybe to sell some of that debt. But it's interesting to see that they're selling the debt and selling futures. NYMEX crude right now up 132, which is a good sign for the global economy if you want to take that as an economic gauge. If you want to take Bitcoin as a risk gauge, it's not a great sign today. But look, we're bouncing back over 36,000 at some point yesterday. And remember, we were below 34,000 yesterday morning. So really interesting to see the swing in S&P futures, the swing in risk indicators like Bitcoin, but positive economic indicators in crude and in treasuries. Anna, what do you see in Europe?
Yeah, so equity market futures in the US in negative territory, and we'll keep that in mind as we look at the green on the screen across this European map. We're doing our best in Europe to hold on to that positive territory, doing it quite well. But of course, this map doesn't tell you the context of yesterday. Losing 4% one day, gaining 1% the next, you're not back to where you started. But that's what we've done here in Europe so far today. Who knows where we end the day? Such has been the volatility over the recent sessions. In terms of what is leading the markets higher here in Europe and leading that rebound, the banking sector to the fore, up by 2.2%, despite Credit Suisse underperforming on the back of that news flow surrounding provisions they're making and also outflows from wealth management. More of that later. I wanted to put in here the ruble, and this shows that we're actually gaining on the ruble this morning, just to make the point that we are seeing a bit of a pause in the selling of Russian assets that perhaps had some spillover into other markets here in Europe in yesterday's session. So that's certainly something we're keeping in mind. We're also seeing some buying of Russian stocks in today's session, although keep an eye on Russian ETFs. I'm told one in the US. There was so much expectation, so much wanting to short Russian assets in recent days that they had to create more shares in that particular ETF to enable the market participants to do that. The euro being sold so that investors can get more safety or perceived safety in the dollar, and earlier on in the session in the yen as well. And Ericsson, I put this share price in here, the telecom equipment maker, this stock up by more than 7% today. A really stellar, in the words of some analysts, report from the company today in terms of their upgrades to expectations and the dividend that they produce and the profits. 5G is really the opportunity here, and Sevian Capital is not good enough for them. They are a shareholder here, an activist shareholder. They're saying that this company still has more to do to convince the markets about the possibilities that it sees, Kaylee, in 5G.
All right, we'll continue to watch those shares throughout the trading day in Europe and see if those gains can hold. And as for what else we're watching throughout the trading day, the International Monetary Fund will launch its World Economic Outlook update at 9 a.m. New York time. Then German Chancellor Olaf Scholz hosts French President Emmanuel Macron in Berlin. There will be a press conference ahead of a meeting that will focus on the bilateral relationship between France and Germany, France's presidency of the EU, and Germany's presidency of the G7. And finally, after the bell, Microsoft will kick off mega cap tech earnings. It reports at 4 p.m. New York time. So those prints we're getting from Microsoft as well as Tesla and Apple throughout the week, Matt, could be just the next catalyst for a tech sector that has gotten badly beaten in the last couple of weeks.
In one direction or the other. Let's talk about that crazy volatility that we saw yesterday. The market action was wilder than most days in history, with the S&P falling about 4% before ending the session slightly higher, as investors try to gauge the impact of everything from Fed tightening to geopolitics and Russia and Ukraine. Let's get more with Bloomberg's Danny Berger. Danny?
Matt, when we look at that volatility that you're describing, the natural question that comes to mind, okay, is this boomerang market, when we get this turnaround, is that a sign of confidence that we can buy these dips? Well, to be clear, a lot of the signals suggest that the kind of action yesterday hints at deeper market trouble. For one, we can look at the historical corollary. We saw the Nasdaq 100 drop nearly 5%, certainly dropping more than 4%, and then ending higher. We have seen that in the past, 11 times to be precise, but when it happened is not comforting. 3 times in 2008 and 11 times we saw that happen during the dot-com bubble. So if history is any sign, it's not exactly a calm period in the market. But one place that I really love to look at in yesterday's session that really shows the market angst is trading in the ETF that tracks that Nasdaq 100. That's, of course, the Qs. And if I can use a highly technical, very CFA word, the trading was absolutely bananas in this thing. We saw record turnover in this thing. The amount of volume traded in this was almost 70 billion. That's nearly 30 billion more than the prior record. And At the same time, options traded in this thing also were at a record. They're really led by the bearish options. Typically, when there's market angst, it goes into the ETFs because these things are really liquid and really easily traded, Anna.
Okay, so the trading was so bananas you had to color it yellow, which I think is important in this context. Yeah. Let's talk about the trading in Bitcoin then. Such weakness in Bitcoin, such movement in tandem with stocks, Danny, the correlation between those two moving to levels we haven't seen.
Yeah, exactly. And for our radio listeners, I did have yellow on my last chart for the banana-e-ness of the market. This one, unfortunately, I do not. I'm looking at correlation between the Nasdaq and Bitcoin. Now, the thing here, and I know, Matt, you're not the biggest fan of correlation charts, but I do think this one is telling because previously in 2019, not a lot of correlation, not a lot to take away from this. We have seen Bitcoin and stocks more closely linked, but if anything, it doesn't necessarily say that Bitcoin is a leading indicator. It just shows how Bitcoin is reflecting a very similar concern that we're seeing play through stocks. You see Bitcoin gaining yesterday, eventually stocks gained, Bitcoin taking losses. Now, the new floor, many strategists say for the cryptocurrency is 30,000, which would be more than 50% losses from the top. And it just shows how investor psyche is likely taking a brutal beating when you have all these very speculative assets that people pour to now chopping the other direction.
I'm not anti-correlation chart. Yeah. The function is very sophisticated and it can be easily manipulated for those who don't understand how to use it, but it's a great function, CORR. Go. Danny, thanks very much for that. Bloomberg's Danny Berger talking to us about the volatility. A lot of it seemed kicked off by the geopolitical news yesterday. The Biden administration now is offering a show of military force along with diplomatic efforts to defuse the crisis in Ukraine. The Pentagon has put as many as 8,500 troops on alert for deployment to help NATO forces in Eastern Europe. This comes after President Biden held a call with European leaders yesterday.
I had a very, very, very good meeting, total unanimity with all the European leaders.
Emily Wilkins, Bloomberg government reporter, joins us from D.C. So, Emily, does this mean the U.S. is willing to back a fight against Russia militarily?
So at this point, the U.S. and the Biden administration are really painting this move to send these 8,500 troops as a proportional response to what Russia currently has at the border. These troops are going to be joining NATO forces, sort of supplementing that they're already there. They're not going to go into Ukraine at this point. These troops are not officially deployed. At the same point, this does kind of show the Biden administration taking a stronger stance than what we've currently seen against this Russia buildup at the border. And you've seen both President Biden really focus his efforts here on this particular part of the world in recent days. You've seen Congress go ahead and ask that. Both House Speaker Nancy Pelosi, Senate Democratic leader Chuck Schumer asked for these bipartisan briefings from the White House. And I think at this point, the U.S. is really trying to put itself in a position where they're much more involved in the region should a strike occur.
Well, Emily, you mentioned bipartisan briefings. How much bipartisanship is there on this issue? Is there agreement on both sides of the aisle?
There's actually a lot of bipartisanship here. Even though Democrats and Republicans have some different ideas about what sanctions are needed, you've seen senators come out and say that they realize that this needs to be bipartisan. It needs to be a strong, clear message from Washington to both Ukraine and Russia about where the U.S. stands. So lawmakers, they're not in Washington right now. They're back in their districts, but they are working on a bipartisan bill that could already put sanctions against Russia, potentially even before they invade, if they invade.
Emily, thank you very much. Emily Wilkins, Bloomberg Government, with the perspective from Washington. On to the corporate news flow. Credit Suisse will take a large legal charge in the fourth quarter and warns of outflows at its key wealth business. This caps a tough year for the bank after a series of scandals and management turmoil. Joining us now, Tom Metcalf, Bloomberg's European banking reporter. Tom, what on earth does this mean for Credit Suisse's earnings then? This has been a tough time. Now we've got more bad news this morning.
Yeah, exactly. The sort of bad news keeps on coming for the bank, and effectively, if you're an investor in the unit, you're just going to be very disappointed again after, sort of a year of bad news.
Yeah, I was going to ask if they can get out of this cycle, but, it just seems never ending for Credit Suisse, almost like Deutsche Bank a couple of years ago.
Yeah, exactly. That's a great comparison. When people now think of banks in trouble, they turn straight to Credit Suisse. So, the question is maybe they've managed to clear all the bad news out before Q4, and then 2022 looks maybe a bit positive. But, given the past 6-12 months, I probably wouldn't hold your breath for that.
All right, Bloomberg's Tom Metcalf, thank you so much with a look at one of the big banking stories this morning. There's also a story we are following in the chip space. The breaking headline just crossing the Bloomberg terminal. NVIDIA is said to quietly prepare to abandon its takeover of ARM. Of course, this was supposed to be a $40 billion chip deal, NVIDIA trying to buy ARM from SoftBank. They announced this back in September 2020, and it ran into some serious pushback from regulators. So now reportedly, NVIDIA is looking to pull back from that deal. That stock is down about 2 percentage points in pre-market trading here in the U.S. And as for some other stocks on the move in pre-market trading, we do have one moving to the upside, and that is IBM. It reported earnings after the bell yesterday, its strongest sales growth in about 10 years, thanks very much to the cloud. As a result, that stock is up the better part of 3% before the bell. Moving to the downside, though, meme stocks. And this is a very key date for meme stocks, Anna, because it was on January 25th, 2021, that GameStop mania officially kicked off. So it is the one-year anniversary. It has been a wild ride for the likes of GameStop and AMC, but lately that ride has been to the downside. They are each down about 50% over the last 2 months, as you see a lot of money coming out of some of those frothier areas of the market, and those losses are continuing today. They're down about 2.8 and 3.8% respectively before the bell, Anna.
Now for something a little different, Kaylee, we have some red headlines crossing the Bloomberg in relation to parties that were said to have taken place at Downing Street during lockdown periods, during the height of the pandemic. We've been covering these news lines for some time, of course. Now we're hearing this morning that the London police are to probe Downing Street parties during lockdown. So they're officially going to open up a probe into this. This is going to be investigated by the police here in the UK. This, according to the Metropolitan Police's Cressida Dick, who is speaking at a hearing. You're not seeing pictures of her there, but she is speaking at a hearing. There are some events that will not be probed, but some of these have been assessed, and the police are going to look into it. This does not mean that penalties will be given. Cressida Dick, you see her there, is saying this morning. Now, coming up on this program, more on the markets with Elliot Hentoff, State Street Global Advisors, and Matt Maley of Miller Tabak. So much to talk about, from the Fed to geopolitical risk, of course. And talking about that geopolitical risk, what does that do to the European economy? We'll talk to Anna Titereva, UBS European economist. That's coming up shortly. Plus, part of our interview with Bridgewater Associates founder Ray Dalio. What he sees is behind the massive market moves. Don't miss that insight. This is Bloomberg.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
We don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing on Friday on Quick Take and over the weekend on TV and online.
Big effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
Earning earnings season is here.
It has been brutal.
A little bit of disappointment in some of the early reporting.
Bloomberg is fastest with the numbers and analysis.
This is a mighty crash.
What to buy and what to run away from.
Bloomberg, the fastest numbers and analysis you trust.
The Federal Reserve has been behind the curve, slower to tighten monetary policy. And as a result, we're now starting to see the rise in interest rates to be able to deal with that. As that happens, all assets compete with each other. That means all the other assets have to adjust. We're in a process of making that kind of adjustment.
That was Bridgewater Associates co-chairman, co-CIO, and founder, many titles there, Ray Dalio. You know him, speaking on the David Rubenstein Show, peer-to-peer conversations. You can catch that full interview next week on Bloomberg Television. Joining us now for his view on the Fed, Elliot Hentoff, head of policy and research at State Street Global Advisors. And Elliot, you know, we've been hearing a ratcheting up of expectations for rate rises this year by the Fed, and yesterday was no different, but all of a sudden the markets went haywire around 5:30 this morning yesterday, and it seemed to be on the geopolitical news. What do you think kicked off the incredible bout of volatility?
Yeah, I think, Matt, you and I were just chatting in the break. It's everything going into 2022, we all knew volatility would be up. We're in the process of normalizing the policy environment, normalizing the economy from kind of all the crazy disruption that we had with the pandemic. And it's like going on a roller coaster. You know it will be bumpy. And even though once you expect it, when you experience the bumpiness, it's still somewhat of a surprise. So what happens is when you're normalizing, any small trigger can basically amplify the volatility, can amplify the swing. And that's what we've been having yesterday. It didn't take much to basically turn the market one way and then back the other way. But I want to really point one thing out to viewers. You know, a swing like that, we heard it before from your colleagues. We've seen it in October 2008. You saw it during dot-com bubble. We're nowhere in a systemic problem like we were during those eras. So it's really not justified. So the volatility should shake itself out and normalize too.
Elliot, good morning. Yeah, we haven't seen volatility, the intraday volatility that we saw on the Nasdaq, I think, since 2001, the aftermath of that dot-com sell-off. So that's just the incredible historical context to what we've seen this week in markets. How would you expect the Fed to be looking at what we've seen in markets? And actually, how would you expect the markets to react if the Fed comes out and reaffirms what it's already said about the number of rate hikes that might be on the table and the way it might use quantitative tightening? If it just comes out and says what it said before about what it might or might not do this year, do you think that will calm investors or lead to further panic?
If I was a FOMC member, I would be quite pleased with the market behavior in January. You've had clearly a sell-off in risk assets, but you didn't have crazy turmoil in the rates market. I think you just had the 10-year up at 178. Credit's not overreacting either. So in many ways, this is, I think, what the Fed is happy to see. The market is doing some of the lifting of what is required. So I think the Fed could be pretty confident to say we reaffirm our previous stance, we reaffirm the path of travel, and yes, that's not. I wouldn't say it will lead to another bout of volatility, but I think the market will have to take it in stride.
So, Elliot, how much, though, is the Fed going to be able to tolerate? Where is the Fed put now?
That's an excellent question. The Fed put clearly has shifted. I think you're going to see a year of two halves here. The first half is if the Fed action is clearly front-loaded. It's front-loaded to winter and spring of this year. And a lot of it will, as I talked about, the normalization process. Even if the Fed did nothing, you are going to see some type of normalization on the inflation front. But now, obviously, the Fed, as Dalia pointed out, is a little bit behind the curve. So there has to be a little bit more front-loaded action to engineer that normalization. But mind you, the put still remains in place to a degree. We've had a huge risk-on rally for about a year and a half. It's fine if there's a little bit of a drawdown, a little bit of a tightening of financial conditions from the equity market, from the bond market. That helps the Fed. It means they have to do less. And frankly, I think in the second half of the year, our discussion will be quite the opposite as to, how much will the Fed maybe pull back from some of the projections we talked about now in January.
Elliot, I don't understand why you differentiate what we're going through now from what we went through, for example, during the dot-com bubble or the great financial crisis in terms of systemicity, if I can make up that word. I mean, the fiscal and monetary stimulus in the tens of trillions of dollars globally, how does that not cause something as systemic as, an overvaluation of stock market prices during the dot-com bubble, which must pale in comparison?
Yeah, well, the difference is that, well, first of all, the financial crisis meant our financial system was collapsing, credit channels, transmission for monetary policy was going to be broken, all of that. But the dot-com cycle is different because you had a global downturn happening. So the question was, to what degree could policy support what was otherwise a downturn? Here it's the opposite. You have global growth, well, maybe not accelerating, but still growing at a fairly healthy clip. Some parts of the world are actually going to be accelerating, particularly ex-US. And so that's a very different environment. Earnings, the actual earnings that companies will be generating, well, yes, they're disappointing, maybe some of the projections, but they're still pretty decent. This is not a downturn. So it's about normalizing the withdrawal of the morphine that we've got into that we've gotten injected into markets. Pulling that back, it's a little bit of withdrawal syndrome for drug addicts. It's a normalization process, but it's not an existential crisis like it was in the previous episodes.
Elliot, thank you very much. Elliot Hensov of State Street Global Advisors. Thanks for joining us. Now let's get a First Word News update. A new Pentagon assessment casts doubt on whether the U.S. Navy's costliest warship can defend itself. The Defense Department's testing office found mixed performance by the combat system on the USS Gerald R. Ford, a $13 billion aircraft carrier. The report also said the carrier's aircraft launch and recovery systems are poor or of unknown reliability. Unilever plans to cut about 15% of senior management roles, roughly 1,500 jobs. Bloomberg reported earlier that CEO Alan Jope believes that the number of managers at the consumer goods giant has slowed innovation. The cuts come at a time when activist Nelson Peltz has taken a stake in Unilever. Shares of Ericsson rose the most in almost a year. The Swedish telecommunications company raised its dividend and reported profit that beat estimates. Like a lot of other companies, Ericsson had to deal with supply chain problems.
Supply chains around the world are very constrained, and it is a difficult supply situation. So far, we've been able to cope with the supply constraints, and the uncertainties are going to be here for, I foresee it into 2023, actually.
Ericsson sales fell in China, but that was offset by demands for upgrades to 5G in the rest of the world. And British Prime Minister Boris Johnson is facing allegations of more rule-breaking parties during the pandemic. His office has confirmed that staff gathered in Downing Street to celebrate his birthday during the first lockdown in 2020. Meanwhile, London police now say that they will investigate the parties, and a government report on the parties may be published this week. That could add to the political pressure on Boris Johnson. And I know that across the Atlantic, the details of this will be lost a little, but suffice to say, there have been a lot of allegations of the parties that took place at Downing Street. We'll wait to see what the internal civil servant inquiry says about this. But the big question is whether Boris Johnson as Prime Minister can survive, and the involvement of police here must make that more complicated.
Anna, I have heard that they partied pretty hard. Is it true? Reports have said they were sending staffers to the local 7-Eleven with suitcases to fill up with booze.
That has been reported. That has been reported, yes. And who was there at which particular party and which particular rules applied at that time, but that certainly was not a good look, especially when that particular gathering occurred.
Not a party until something gets broken, right?
Just before a big state funeral here in the UK. So a lot to talk about there when it comes to the future of UK politics. We'll get back to the markets conversation, though. That certainly is a big preoccupation for us here. Matt Maley, Military-backed chief market strategist, joins us next. This is Bloomberg.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And here is what you need to know. Strategists are predicting trouble for U.S. stocks after that massive U-turn left benchmarks in the green. Bespoke Investment says that the Nasdaq historically drops after a big reversal. U.S. futures are lower today. The U.S. has put as many as 8,500 troops on alert for deployment to help NATO forces in Eastern Europe. Meanwhile, President Biden says he had a great call with European leaders, trying to come up with a unified position on Russia and Ukraine. And in corporate news, Credit Suisse is capping a year marred by scandals and turmoil at the top. The Swiss bank will book more charges for legal matters in the fourth quarter. Plus, it warned of outflows in its key wealth business. That is a look at what you need to know this morning. Matt, what do we need to know ahead of the market open in the United States?
Well, we have a couple of conflicting indicators after the massive volatility that we saw yesterday. We have risk indicators that are down, economic indicators that are looking a little bit better. The risk indicators are the S&P futures here down about 0.6%, and Bitcoin down almost 1%. Economic indicators, I would say, NYMEX crude is higher right now, and investors feel comfortable enough to sell off the perceived safety of government debt, as we say. So 178.85 on the 10-year yield, NYMEX crude at 84.29. Bitcoin is interesting because it actually came up pretty strong yesterday. Now it's trading at 36,472, even with this 1% loss. So that's a big turnaround from the drop below 34,000 that we saw at this time yesterday. S&P futures, of course, just unbelievable yesterday. Down 4% and then back up to finish positive at the end of the session. There are only a few times in history, Kaylee, where you see moves like that.
Yeah, it was absolutely wild, Matt. And of course, we've been talking about the correlation between risk assets and Bitcoin, but there's a very clear correlation between Bitcoin and crypto stocks. And that is evident once again in pre-market trading this morning. We are off the session lows for both Bitcoin and the likes of Riot Blockchain, but it's still lower by a little more than 1%. Also lower is NVIDIA. And this is on news that just crossed the Bloomberg terminal about 20 minutes ago, that it is looking at abandoning its takeover offer for ARM. Of course, that $40 billion deal ran into a lot of regulatory trouble. And so NVIDIA maybe is walking away from that. Right now, those shares are down about 2.5%. There is a positive story out there, though, and that is IBM. It reported after the bell last night, strongest sales growth in 10 years. So that stock is up about 3%. And of course, we're going to get more earnings throughout this week, including Microsoft coming up after the bell today. Anna, ahead of that print and ahead of the opening bell, Microsoft shares are down about 0.3% before the bell.
A large corporate to watch later on. Let's focus on what is trading right here and now, and that is European equities, of course, Kaylee. And we're hanging on to positive territory. We sold off 4% on European stocks yesterday, making up around 1%. So we're not making up for all of the losses of yesterday, but we are managing to keep our heads above water here in Europe, despite the moves to the downside, adding in the moves to the downside in US futures. Maybe some of that has to do with a little bit less nervousness and risk aversion towards Russian assets today. This is the Russian ruble actually gaining. We've seen Russian stocks gaining. There is a sense of nervousness, though, perhaps around FX markets more broadly. Some on FX desk flagging that they're seeing euro selling as investors try to get into the dollar or decide to get into the dollar as a haven at a time of increased geopolitical tension. Maybe the contrasting Fed and ECB policies have something to do with that as well. And Ericsson also here on my list because, of course, we've got earnings season coming through. European corporates just starting to get into their stride in terms of that reporting. And this was a positive one. This was a good story for markets, but not good enough for one of the activist investors that has a stake here, saying that this business needs to do more to explain to markets how it can win from the 5G rollout then, Matt.
Well, Anna, I'm going to pick it up here because I think there's a lot of explaining that needs to happen, not just for Ericsson, but also in regard to what the heck happened yesterday. Joining us now to hopefully help answer that question is Matt Maley, Miller Tabak, Chief Market Strategist. Matt, when you look at the action from yesterday, can you draw any logical conclusion about what happened and what that may indicate the path forward looks like from here?
Yeah, Kelly, I think part of it had to do with this situation where we had some forced selling. I mean, we talk about what we get a washout trade or capitulation. And a lot of people usually think, well, capitulation means that we had some people panic, and that's certainly part of it. But also, as we do know that from levels of margin debt and such that there was a lot of leverage in the marketplace going into this year, and leverage helps on the way up. But as the market rolls over, we see some unwinding of that leverage, and I think that's what we saw. I mean, we saw each of the last 3 days of last week, the market closed on its lows of the day, and I think we saw some of those margin calls and things like that kind of caused the forced selling. Yesterday we saw it again, and I think once that finally kind of got washed out and people were done with that, there was nobody left to sell, and that's why we got this major snapback rally.
Well,
the concern though is that.
Matt, are people done with that in general? Was that capitulation? Have we seen it?
That's the big question, Matt, because and I don't think it is. We had a huge, massive levels of margin debt going into this year. It has certainly come down some, but it takes time for that to get unwound. We've seen that in 2018. We had record levels of margin debt. It took several months for that to get worked off. It doesn't just happen overnight. And so I do think that yesterday's bounce will be one that will probably. The futures are down today, but they're down about half as much as they were. An hour or so ago. So I think that bounce should last a little while, but I do think we'll see, more volatility and probably lower lows. So I think we've gone from a situation that on a near-term basis that people need to sell the bounces rather than buy the dips.
I hate to ask you kind of the horse race question, but it begs to be asked, how much lower could we go? I mean, before that margin is all unwound, where do we end up?
Yeah, I think when this whole thing kind of came around, especially around November and December, when the Fed really started signaling they were going to be much more aggressive with their tightening, I really thought we'd see a deep correction in the S&P 500 take us down 15 to 20%, and I still think that's probably going to be the case, which of course take the Nasdaq down even further. The thing for investors right now, though, is so important is that maybe raise a little bit of cash, not a lot. You don't have to raise 25% cash, but you raise a little bit of cash on the bounces, and therefore, my point is embrace this situation. They're healthy, they're scary, but they're also normal, and like I said, healthy. And if you're the ones who can embrace it, you'll be the one who's keeping your head while others are losing theirs at the bottom, and you won't be selling right at the bottom with the absolute worst time. You'll be the one who has the confidence to buy.
Matt, in the context of that, if we're right-sizing monetary policy right now, if that is what the Fed is trying to do, get the monetary policy support level right for the economy that the US sees right now, what does right-sizing equity markets look like? Where do we get down to, perhaps in relation to March 2020 levels, for example?
You know, that would be, of course, be very, very deep, because then we're looking at more like a 30% correction. That is possible, and because we tend to overshoot in both directions. We overshot to the upside last year, and we could overshoot to the downside. The thing is, though, is that when they're normalizing interest rates, they're normalizing the balance sheet. That means stock prices and stock valuations need to normalize. So I think we need to see those get down into the 16 times, 17 times earnings, and things like price to sales, which is even more important than I think most people realize. Get those normalized, and again, that will cause closer to a 20% pullback rather than the 10% we've seen in the S&P so far.
Matt, what do you think is more important this week, the Fed decision tomorrow or the tech earnings that we get over the next 3 days?
I think the tech earnings is going to be the most important. I mean, we kind of know what the Fed's going to do. If anything, they might be, a little bit softer. I don't think they will. I think they're going to, to keep their, their viability, they need to stick with what they've been saying. But we know what that's going to be. Where the uncertainty really lies in the tech earnings. So if they can come through a little bit better, we see IBM with some good numbers this week. Last night, we see Microsoft and Apple. That will certainly help the market on a near-term basis. And again, when markets see corrections, deep corrections, they never come in a straight, or almost never come in a straight line. We see sharp bounces along the way. Hopefully, we can get something out of Microsoft, Intel, and these other names. Alphabet, Google, especially, could be one of the names that could really help the market stabilize here.
Yeah, we'll see how much comfort we get from that tech earnings story. Matt, thank you so much. Matt Maley, Militabank, Chief Market Strategist. Coming up on the program, we'll be back to talking about geopolitical risk. What does that mean for European equities? What does sanctions mean for European economies? Anna Sitareva, UBS European economist, joins us next. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
There is a confirmation of unity of the European Union. There is a confirmation to help Ukraine to address this crisis. And also there is a readiness to take measures if necessary and to impose new sanctions, both individual and sectoral sanctions on Russia.
Ukraine's ambassador to the European Union, speaking with Bloomberg's Maria Tadeo earlier this week. For more on the crisis over Ukraine, we're joined now by Rosalind Matheson, Bloomberg executive editor for international government. Rosalind, help us understand where we stand on the risk here, because when we listen to Ukraine, they seem to want support from Western allies. They want equipment, for example, and they clearly don't believe Russian assurances that no invasion is planned. But at the same time, they don't want to see anything that looks like panic, and they didn't respond well to embassy family members being withdrawn from the country. What's the latest?
Well, that's right. You can see that even as tensions are definitely increasing, you're seeing a high level of caution on all sides about what they're saying and what they might do, even as the US and NATO, for example, are saying that they're prepared to move NATO troops further into Eastern Europe and to bolster that area, including with exercises and ships, and as countries including the US and the UK ship more defensive material into Ukraine. They're all saying all of this is defensive. None of it is about trying to prod Russia into action or to goad it into doing something, and reassuring, if anything, Russia by saying, look, just because they're all there doesn't mean that we're preparing to do something. And also they're very clear that they're not prepared to send troops into Ukraine itself if conflict does actually break out there. So you're seeing trying to send a message of toughness and unity, including on the military side, but also not going so far as to take action that might force the Russian president's hand in terms of moving perhaps into eastern Ukraine and starting an incursion or even a broader invasion.
Yeah, minor incursion or a full-scale invasion and occupation. Roz, it's hard to talk tough when you rely on the aggressor for your energy needs. Is it possible, I mean, if Russia were to go into Ukraine, would Europe even be able to stop funneling Vladimir Putin billions of dollars to fund his antics?
Well, that is the real difficulty, and you're seeing European nations essentially contort themselves a bit at this point in time about how they would respond. Like what kind of action, for example, would warrant sanctions, would warrant heavy penalties? Is it incursion? Is it a full invasion? Is it a cyber attack? Is it efforts to destabilize Ukraine from within? What kind of action on his part would warrant sanctions, and then what kind of level of sanctions even? And right now, European nations are very cautious about discussing specifics on sanctions among themselves out of those concerns, and as you note, very much reliant on Russian gas into Europe, and that makes Europe much more vulnerable to economic hits from this than, say, the US, and that's why you're seeing differences. Perhaps the US is pressing really hard for a proper sanctions package to be developed, and Europe just remains much more cautious because they're really close to Russia in terms of retaliation, economically and otherwise, and that's a real difficulty in that unified message again.
All right, Bloomberg's Rosalind Matheson, thank you so much. And let's continue this conversation now with Anna Tetereva, European economist at UBS, who joins us now for more on this Ukraine issue. Just to pick it up on that point, Anna, can Europe withstand the economic consequences if severe sanctions are put in place on Russia?
Yeah, when it comes specifically to the impact of sanctions, when we look back at, for example, 2014, there are some estimates that suggest that the impact on Germany of the sanctions introduced by the EU accounted for about 0.2 percentage points loss of GDP. Now, given that the share of exports to Russia at the Eurozone level is somewhat lower than for Germany, the impact on the Eurozone would likely to be even smaller than that. So overall, that seems that the impact, at least looking at previous period, seemed to be relatively small.
You say relatively small. We're showing a chart here, though, Anna, that talks about lost trade due to sanctions on Russia going back to 2014 and the period around it. Even if it is relatively small, relative to other European nations, the risk, the economic risk, falls heavily on Germany. And those links, those economic links between Russia and Germany, well known, of course. Does that go some way to explain why Germany finds it perhaps more difficult to come to a common understanding with other European leaders on sanctions?
Yes, certainly Germany seems to be the most exposed given its trade channels. But even aside from that, when we look at sort of the most immediate channels of how the shock is likely to feed through, we emphasize two channels, confidence and also price effect, price channel. We've seen that a big spike in gas prices last year already had a very significant impact on the region. We saw a big increase in retail gas and electricity prices across the region, eating into households' real incomes and also, production costs of businesses. So any worsening in geopolitical situation risks another spike in gas prices, which would further weigh on consumption across the region and also would likely affect inflation dynamics, at least in the near term.
What kind of inflation expectations, Anna, should we have for Europe outside of, the geopolitically caused gas spikes? For example, wage growth, is that as substantial in Europe as we're seeing in the U.S.?
Yes, so overall, we think that the 5% inflation print that we saw in December has likely marked the peak in the Eurozone inflation profile. We do expect a decline in January that's largely driven by sort of mechanical factors related to German VAT and CO2 pricing scheme. However, risks, both in terms of near-term and medium-term, are skewed to the upside. Near-term risks are largely around supply bottlenecks and also, importantly, energy prices. And wage growth is, we think, the key factor to look at when we talk about a medium-term inflation outlook. Final point I would make regarding wage growth: so far throughout the pandemic, wage growth has actually slowed down at the Eurozone level, but we do expect this to change this year, and we do expect a significant pickup in wage growth, especially in the second half of the year.
Anna, thank you so much. Thanks for joining us. Anna Tisareva, UBS European economist, with reflections on the risks for the Eurozone economy and the links with Russia. Coming up on programming a little bit later, Geeta Gopinath, IMF First Deputy Managing Director. That conversation at 10 a.m. in New York, 3 p.m. in London. This is Bloomberg.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Dogs and spend thousands and thousands of dollars on them.
You're indicating you are not one of those people, Tom?
God.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. And also joining us now, Tom Keene, co-anchor of Bloomberg Surveillance, trying to help us make sense of these markets. Tom, can we draw any conclusion from what futures trading or even early trading indicates about where we're going to end the day?
Really good question here. What I do is I triangulate across the equities, bonds, currencies, commodities, and I sort of see a soup and a mess. And maybe, Kaylee, that's because we're upon a Fed meeting. But the gyrations yesterday were extraordinary. I know everyone's seeing all sorts of historical looks. What I did is just go to the VIX and the big figure move in the VIX. And we all know this is, not so much never been seen before, but a hugely rare occurrence. Higher is ugly, the red, and that's 19 points, I believe, 19 big figures, way through 30 level. And then we came in abruptly into the yesterday's magnificent 27 big figure move in the VIX. I will say there's been a lot of analysis that this is maybe something we'll see to lower equity prices in the future. I'm not predicting that, but that's where we are as we pick up the pieces this morning.
Yeah, no escaping the volatility then, Tom, it seems. Certainly extensive in yesterday's session and some of that spilling into Europe as well. I was talking to a guest earlier on today about, if we are, broadly speaking, trying to right-size monetary policy, that is going to have an impact then on the right-sizing of stocks. And it's interesting to think about where that takes us on stocks. One guest suggesting that could result in a 20% drawdown on the S&P.
Yeah, you got 5 people, you got 6 opinions, Anna. I'm not going to go there. What I will say is Ben Laidler, who's been wonderful since Christmas Eve of 2018, reaffirms his bull market call this morning. He says this is highly normal, and he looks again for earnings to surprise. And as you know, we get some nice important industrial reports today in 3M and in GE as well.
All right, Tom Keene, co-anchor of Bloomberg Surveillance, thank you very much for joining us. And other than the trading action and Fed policy, take a look at what else we're watching today. I am watching mega cap tech results. Microsoft will be first out of the gate after the bell today. Remember, this is a stock already down 12% in 2022, so the bar's pretty low going into the print. My question, Matt, is can Microsoft today, Tesla and Apple over the coming days revive this tech sector, which even after yesterday's slight gain into positive territory is still really, really bruised badly on the year thus far.
Yeah, I think everyone's going to be watching that incredibly closely. I'm also going to be watching the car sector as usual, but I have a very special guest later on today. I'm going to talk to one of the preeminent car guys of old Detroit, Mark Royce at GM, who is also laser focused on climate and EVs. I remember about a decade ago driving around Detroit with him in a Chevy Bolt. And now, of course, they've released a new Silverado EV, or they've shown it. They've got the electric Hummer coming out. So we'll talk about that. But I also have questions about big, old gas engines. I still love the 6.2-liter V8 that they've got in the Silverado, Sierra, Tahoe, Yukon, and I wonder when that's going to be hybrid. I have a million questions for this guy, so I'm pretty pumped.
You have. Yeah. I hope you've got a lot of time for this conversation, Max. It sounds like you've got a lot to fit in. I'm going to be watching UK politics. We heard at the top of the hour from the Metropolitan Police Commissioner, so the commissioner who runs the police force here in London, that they are going to be investigating allegations of parties at Downing Street, the home and the workplace of the Prime Minister Boris Johnson during lockdowns in 2020. Well, I say 2020. We're not sure exactly which of the parties that are alleged to have taken place the Met Police is going to be investigating, but they will be looking into some of them. We're also waiting for a report from a civil servant, Sue Gray. I would say that the timing of the news on both of those, that report and the investigation by the Met, now pretty unclear. So we'll have to wait and see when those land as to what the polling looks like and what the political fortunes then of the Prime Minister will look like. More Bloomberg surveillance is ahead. We'll hear from Ryan Williams, Cadre Partners CEO, and others. This is Bloomberg.
Do you think that electric vehicles could reach 10% of the American market by the end of this year?
That's difficult to say, like you said, because it'll be both, not only demand, based on the demand we are seeing for our vehicles, and the rest of the industry is seeing. It feels like the demand is certainly there. But the question will be, how quickly can we, all of us, execute to build capacity to meet that demand? And that's what we are very busy doing. Within the next 24 months, we expect to get to about 600,000 battery electric units globally. And that's before our bigger investments that we're making in Kentucky and Tennessee, both for batteries as well as assembly, come online, because they don't come online until about 2025.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
A lot going on right now for the market to digest. The market is near oversold territory.
The Fed is more likely to be responsive to credit conditions than they are to the S&P 500.
I think it's really what's being priced in is a lack of edge.
I think the outlook for the balance of the year is a bit more constructive.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a mental day from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Once again, we are lower on the S&P by more than 1%, on the Nasdaq down by 1.6 after the wild swings, TK, of yesterday.
I'm going to go right to the VIX, John, a 32 level right now. Clearly, that's an angst-driven number as we go into a 2-day Fed meeting. And, you know, to the points that were made in the opening there, do they really care about the equity markets? I'm not so sure they care about the equity markets. There's so much else going on.
We'll find out tomorrow. For the South side, Tom, the bulls are still bullish. The bears are still bearish. Jonathan Gulliver, Credit Suisse, said the following: there's no smoking gun here that says something in terms of the long-term fundamentals has changed.
Isn't it fun? Ben Laidler, who's been right since December of 2018, reaffirms optimism today off earnings. He comes out, John. I mean, I didn't do this. I was looking for an entry point yesterday, John, and I had to walk the dog, so I missed it.
Lisa, if you missed yesterday in its entirety, don't worry, you missed nothing. We finished the day positive, 0.5% on the Nasdaq. Nothing happened.
The idea of a 4 percentage point swing is massive, considering the fact that the last time that we saw this scope was back in 2008. Lou Wang wrote a great article on the Bloomberg about this. And then before that, the dot-com bubble. So how much does this actually indicate? Not that there is a positive sentiment that kicks in at the end of the day, but turmoil that could potentially continue akin to some of those other periods.
We got a ton to get through this morning. Let's whip through the price action and get you up to speed. We're down around about 1 full percentage point on the S&P. Equity futures on the S&P down 47. On the Nasdaq 100 down 224. We're negative there 1.5%. Yields are just a little bit higher. Breached 190 and backed right away from it. 178.14 now. On the session, yields higher by a basis point. And crude back on the front foot. Lisa, WTI $84 a barrel, up 0.8%.
Year. Honestly, I have to just say, you saying the bulls are still bullish, the bears are still bearish. Honestly, I'm more interested in the bears. Of course I am, but partly because they are the ones that I'm looking to capitulate. If the bulls are still bullish, of course they are. They should like these valuations where they are better than they have in the past or 2 weeks ago. Okay, 9 a.m. Here's some of the data that I'm looking at. The S&P CoreLogic Case-Shiller 20-City Home Price Index. They come out in terms of how much momentum there is behind some of these price gains. Do we see that deceleration continue to accelerate? how much does that speak to, I don't want to say it, but transitory nature of inflation? Because this really does feed into rent prices, at least with a lagging indicator. At 10 a.m., we get U.S. Conference Board consumer confidence for the month of January. Honestly, I'm less interested in the headline numbers than the trend of some of the economic data. We've seen a softening when it comes to the economic surprises, more negative ones than positive, according to the Bloomberg Economic Surprise Index. At what point is this Omicron? At what point is this something else? At what point do we start to see a turn as we start to move around and populate in a more normal way once again? And aftermarket, Microsoft is reporting its earnings. I just want to highlight the divergence between the FANG names year to date. You could see that Microsoft down 12%. Just if you take a look at the range here, Netflix absolutely crushed, 38%, 36% down, whereas Apple's performed a little bit better, less than 9% of a decline. John, how much do we start to talk about FANG as more idiosyncratic stories than a wholesale group?
You're trying to get Tom going, aren't you?
100%.
Just a little bit, just poking the bear.
I'm going to call it meta.
Do that a little bit more, a little bit later. We've got a ton of research to get through as well. This from Marko Kolanovic of JP Morgan, Tom. Recent bearishness in equities is overdone and out of line with activity momentum, easing bottlenecks, and what we expect to be a strong earnings season.
Yeah, the summary, John, that I saw, and I don't have a strong opinion on this, but people centered back to what is growth going to do, and whether it was Kit Jukes with, I thought, an exceptionally sharp note this morning, or frankly others, the idea of slowing growth, slowing demand, or the mandate that the Fed must slow demand to get inflation down. These are the dynamics leading to this new volatility.
Don't you think, Tom, that sell-offs bring the best out of the South side? I always think that. It's so boring when it's just a bull market, a straight line from left to top, right, and it's the same old thing over and over again. Julian Emanuel of BTIG came out with some great work in the last 24 hours, Tom.
Yeah, really sharp note with Ed Hyman, Julian Emanuel writing about the idea here of what does the Fed have to do and what is the summary of all this, and the summary is to watch economic growth.
I should say Julian Emanuel now of Evercore, Tom, and thank you for subtly correcting me there. No longer at BTIG.
Well, that's okay.
Chris Harvey of Wells Fargo.
That's your mistake for 2022.
Joins us now, the head of equity strategy. Your line, Chris, the high-volume cathartic puke we were waiting for. Chris, what's that?
Well, first off, that's my scientific term. And typically what we see at the end of the sell-off is we see volume increase. We see money move from the weaker hands to the stronger hands. And that's exactly what we saw yesterday. Yesterday, there were probably three things that we wanted to see and three things that we got. The VIX at 39 or close to 39. We don't think that's sustainable based on the fundamentals. Two, you had small caps outperform large. That's typically what you see when you have a very aggressive hedge fund degrossing or the end of a very aggressive hedge fund degrossing. And the last thing is, again, as you point out so eloquently, that cathartic puke that we needed, that capitulation of those weaker hands, and now we can move forward. And that's exactly what we got.
What about the catharsis across the x-axis? We seem to be doing catharsis in a 3-hour span. I don't buy that. If you go back to John Magee, 1942, in a slower, maybe 44, in a slower time, catharsis took a couple days, even a week. Is the new catharsis minutes?
Tom, you know, everything happens fast nowadays. So can we have more of a sell-off? Sure, we can. But yesterday was one heck of a sell-off. I think every time I looked down, we were gapping lower. If you looked at some of the stories, we did hear about some hedge fund liquidations. We did hear about margin calls. We did hear about some capitulation on the retail side. And I guess, as we were saying before, everything just happens a bit quicker nowadays.
Okay, well, it's quicker nowadays. I'll go with that. So do you step in and buy this morning? What does UBS suggest someone do with not ample cash, but someone managing retail or institutional portfolio that does have cash on board?
Wells Fargo. I'm pleased it's 1-1 this morning already. We call this a draw and go home. So Lisa did the rest of the show without us, which, let's face it, is what people have been waiting for the last few years.
Just what are you buying?
Don't know what Wells. I don't know what UBS is doing, but at Wells Fargo. Wow, this has gone off the rails real fast.
Welcome to the show.
Anyway, back to our show. We think you should be buying here. Yesterday, midday, we wanted to get a note out. I couldn't do it quick enough. And we were looking for a 10% pullback. We were looking for this bend not break mentality to crack. It did. We checked those boxes. As we talked about, we got good information on the VIX, on small caps. as well as our volume or our cathartic puke. And now what we want people to do is we want them to buy our higher COVID beta portfolio. We want them to buy the reopening trade. Fundamentals are improving. The COVID wave is coming down. And what we're seeing is a pretty good opportunity, we think, to get more aggressive and play the economy for now. We think the economy is fine. We think the Fed is doing a good job. And we think the probability of stagflation has diminished greatly as the curve is flattened, as confidence in the Fed has come back.
Chris, is there high frequency data that you're looking at that really edifies this view that we're moving past the Omicron wave and back to this solid growth picture that people believed in so strongly maybe 3 weeks ago?
High frequency data, we look at the COVID cases every day. We look at them on a state by state basis. We look at them on a country basis. And what you expected to see was a sharp run-up and a pretty quick decay, right? We're seeing that. As far as the high frequency economic data, one of the things that we said coming into the year is we thought the consumer needed to normalize. We're beginning to see that. You've seen a lot of disruption on the retail side with people not being able to come into work. I mean, this weekend I tried to go to the library with my son and the library was closed, right? We'll get through that. And now, more importantly, what we're looking at is consumer balance sheets. Consumer balance sheets are quite strong, and that's a very good sign. So we'll have a hiccup, we'll have some, back and forth, but at the end of the day, with consumer spending being strong, with still a lot of pent-up demand on the leisure and the travel side, and on the services spend side, that's where we think people are going to spend their money. I think that's where the real opportunity is.
Do you think we should leave this conversation off the podcast? I don't think this is going to work so well on the podcast a little bit later. Chris Harvey of Wells Fargo. Hey, Chris, we're going to catch up, buddy. As always.
Always a pleasure.
Chris,
Thank you, mate. Thank you. Thank you very much. Some great work from Bespoke in the last 24 hours as well. They said this: Monday was the 6th day since 88 that the Nasdaq had raised a 4% plus intraday decline to close higher. On previous occasions, the index saw a median decline of 5.5% over the next 1 month and a drop of 7.9% 3 months down the line. Lisa alluded to this. When you see moves like this, Tom, usually they're concentrated around times that aren't so pretty.
Yeah, that's true. What I would suggest to the research, John, there's been some serious study of this. I'll give credit to UMass Amherst and also to Vanderbilt years ago, decades and decades ago. It's not the getting outedness that's hard to do. The hard part is when you get out, yesterday afternoon, 1 p.m., you look at your screen after a surveillance nap and you go to cash, except I was already all in cash. But the answer, John, is it's not those calls that are hard. The hard one is to say, let's buy today. Let's get in. And that's what I would really focus on, is the appetite to get back in the market.
We're down 1.4% right now on the Nasdaq 100, just to get you all up to speed. On the S&P, down 0.9%. Saw a preview of this movie before, didn't we, yesterday, and then things turned around pretty violently and pretty quickly in the second half of the session. Lisa, someone messaged me yesterday and said, doing nothing is a strategy too. Doing nothing is a strategy too.
I would argue most people are doing nothing. And I would say this because if you look at the flows data, you have not seen massive outflows. You have not seen the commensurate activity of withdrawing cash. Instead, this is trading. This is a lack of edge and a lack of conviction. At what point is there true capitulation to really move things in one direction or another at a time when there's so much uncertainty? It's not bearish. It's just honest.
Just Lisa.
It's just looking around.
just looking around corners. With authenticity. I get a ton of great messages on the Bloomberg on Twitter. Here's one for you, Tom. My favorite TKism, quote, and I don't have a strong opinion on this, but futures down 0.9% on the S&P on TV and radio. This is Bloomberg.
The next block can't be worse.
With the First Word News, I'm Ritika Gupta. The Kremlin warns that the U.S. decision to put 8,500 troops on alert for deployment in Eastern Europe exacerbates the tensions. The Biden administration says if the troops are sent overseas, they would help NATO forces in the region. More than 100,000 Russian troops have been deployed near the border with Ukraine. Moscow denies it's planning an invasion. And more problems for British Prime Minister Boris Johnson over allegations of rule-breaking parties during the pandemic. London police are now investigating the claims, and Johnson's office has confirmed that staff gathered in Downing Street to celebrate his birthday during the first lockdown. That was back in 2020. A government report on the parties may be published this week. That could add to the political pressure on Johnson. Credit Suisse is capping a year marred by scandals and turmoil at the top. The Swiss bank will book more charges for legal matters in the fourth quarter. Plus, it warned of outflows in its key wealth business. Credit Suisse has been reeling from the collapse of Archegos Capital Management and Greensill Capital. And Chairman Antonio Orta Osario was ousted after 9 months for breaching quarantine rules. Bloomberg has learned that NVIDIA is preparing to abandon its purchase of ARM from SoftBank Group. The company has made little to no progress in winning approval for the $40 billion chip deal. Meanwhile, SoftBank is stepping up preparations for an ARM IPO as an alternative. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mentioned the 1.5 million tests. That's quite a feat. At the same time, I've seen estimates that say that'll get you through about a week or so. What do you do after that?
Let's be smart with our resources. Why not use the test strategically when you need them? How are we using them? A child is diagnosed with COVID in a classroom. We give that entire classroom take-home test kits so their parents can test them, so we can determine if we should close down the school or just the classroom, or what we should do with that particular facility area. What has happened in the past, you had one diagnosis, we want to close the entire school. That just makes no sense. Instead of using our resources in a strategic fashion, the science has shown just because one child has COVID in the classroom, it doesn't mean the entire school or the classroom is infected. We're going to be smarter, and we're going to pivot, and most importantly, we're going to defeat COVID.
Big effort to have more African Americans and more women on boards, but do you think that will last?
I believe that we are seeing a real paradigm shift where we understand that diversity in the boardroom is more than one.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
To recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
Earnings season is here.
It has been brutal.
A little bit of disappointment in some of the early reporting.
Bloomberg is fastest with the numbers and analysis.
This is a mighty crash.
What to buy and what to run away from.
Bloomberg, the fastest numbers and analysis you trust.
What we've seen over the last few decades is less competition, more concentration. That literally holds the economy back.
The President of the United States focused on the domestic issues. Everybody else seemingly focused on the international ones at the moment. From New York City with Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market is down and down hard again, off by 1%, 0.9% on the S&P 500. Futures on the Nasdaq down 1.36% after the monster turnaround in yesterday's session. Negative 4.9% on the Nasdaq at the lows, positive 0.5% at the close. Just unreal. Crude in the commodity market, $84 a barrel, up 0.8%. Euro dollar heading south, Tom, on that currency pair, negative 0.4%, 112.82.
But John, can we agree that across equities, bonds, currencies, commodities, the correlation here off Ukraine is not as tight as it was 24 hours ago?
I don't know how much of yesterday's move, Tom, was actually about
Well, I'm talking
Ukraine.
about the correlations in the morning. The tensions in the morning yesterday were more locked in.
I would say the underperformance in Europe spoke to some of that, Tom. Spoke to some of those tensions. You saw the underperformance in Europe through much of yesterday morning and through the session, particularly in France and Germany.
Yeah, thanks to many people yesterday contacting me on triple leveraged all cash. It was comfortable yesterday.
But sure it was.
There's a lot of people, John, saying, what's a single thing I'm watching in my Continental litmus papers, Euro Swissy, which backs up a little bit, fractionally stronger Euro, weak Swiss. So that's sort of the tone of the tension of the moment. We recalibrate in Washington. We do that with Emily Wilkins, Bloomberg Government, joining us this morning. One of the most interesting things I've seen in the last 24 hours, Emily, is show the flag. Of course, one of the great friends of this program, the former NATO Supreme Commander, Admiral Stavridis, always is talking about nothing's changed. We will show the flag as we did when he first went to see out San Diego. How do we show the flag in Estonia where they request it? How do we show the flag where maybe France doesn't want us to show the flag so much? What's the message this morning?
Well, today the message from President Biden is that they're going to show the flag by not deploying, but having at the ready 8,500 troops. They said that they're not officially deployed. They're going to be joining NATO forces in Eastern Europe. And the White House says that this isn't a change from their stance, that they're expecting that Putin could attack at any point. They want to be ready for that. But this certainly is an escalation from what we've seen the White House's stance be previously. This is certainly much more active, having that presence on the ground.
In your reporting, how does the Secretary of Defense fit into the new strategy? We've had recent White Houses where everything seemed to be run out of 1600 Pennsylvania Avenue. Who's running the strategy, the Pentagon or the White House?
I mean, at this point, it does seem to be a joint effort. You do have the Pentagon involved. You have the Secretary of State's office involved because they are still pursuing these diplomatic options. They're still talking with the European allies, still talking with Ukraine, as well as the White House. This is something that has really gotten the complete attention of Washington within the last week. I would even say beginning the week before, that really all the efforts right now are very much focused on Ukraine and Russia and being able to respond appropriately to this.
Emily, when you talk about a united front, I've been really struck by how many stories have come out recently with one diplomat or one leader saying how united NATO nations are. How true is this, and how much are they trying to give that impression to get a little more clout in terms of jawboning Putin down?
I mean, they're trying to give that impression. You saw President Biden say last night that he got off that call with European allies and leaders saying that they are unified, that they're on the same page. But if you look a little bit closer, that argument begins to break down. You're seeing countries like Germany not saying that they're going to have the same level of support as far as weapons sending to Ukraine and assistance. You're hearing sort of different things from European leaders as far as how big of a threat they feel this buildup on the Ukrainian border border is and how imminent the threat is. So I think on the big picture, everyone is trying for unity. Everyone understands that unity is important. But if you really begin looking closely at the details, it's clear that not everyone is quite on the same page.
Emily, let's talk about what happened yesterday afternoon. President Biden held a press conference. He was trying to talk about the domestic agenda. He's been trying to shift back to that with inflation being in the forefront. We're still all talking about Russia and Ukraine. That is the focus. What have they tried? What can they do to shift the focus, or are we just watching a losing battle?
I mean, to a certain extent, the Biden administration has to do both. They have to do multiple things, right, at this one point. And yes, while yesterday's was focused on inflation, I think if you listen to some of the questions, if you listen to the White House briefing, it's clear that most of Washington's focus is really on Ukraine and this buildup at the border, what that's going to mean going forward. Obviously, inflation is a problem. It's continued to be an issue. You saw Biden yesterday go back to the White House's stance of trying to bring more competition into the market, sort of break up these major corporations. And I mean, it's just a matter at this point of sort of seeing how things go. There have been a lot of theses floated out there for why inflation is at its current rate. But one thing is clear is that if it continues, this is going to be a major problem for President Biden as well as Democrats heading into the midterm.
Emily, I'm guilty of saying this. I said it moments ago. You just said it. Washington's focused on this. I said everyone's focused on this. Is the country really focused on Russia, Ukraine at the moment, outside of DC, away from the journalists that talk about the politics of any given day? Is the country focused on that?
That's always the biggest question here in Washington. What are people focused on outside of the bubble? I mean, look, if you look at polling data, usually Americans are not super focused on the international things. They're much more focused on domestic issues. It is interesting, though. I mean, obviously Americans, they're not completely oblivious to what is happening abroad. You saw that in Afghanistan last year, that botched pullout from the U.S. really led to a decreased opinion of President Biden. You saw a lot of Americans voice concerns about that. You're at this other point for President Biden where he really has this opportunity on the international stage either to show U.S. leadership or to potentially lead to another situation that's going to negatively impact the public's perception of him and his ability to be president.
Emily Wilkins, thank you very much. And just to stress a point, to re-emphasize, Lisa, high inflation is not an asset going into the midterms later this year. Don't ask about that, Lisa, whatever you do.
I love the subtlety and what we're not going to talk about.
We've all been caught on hot mics before. I want to be very clear on that.
Yes, that's true.
It's very easy to get picked up on a hot mic, Lisa. We've all learned that lesson.
And that's probably the reason why President Biden hasn't done as many press conferences as probably some would like.
Because he's got some things to say.
He has some things to say. And you know what? We all have things to say occasionally, but he is the president. I will just say, though, picking up on Emily's point here about not wanting the public's attention to get consumed with a botched move with respect to the military, how much is this an Afghanistani issue weighing on any negotiation with Ukraine and Russia to avoid that kind of debacle?
Well, this will get their attention, Tom. It's another call, another lift to the Brent target. $90 for 22 from Energy Aspects, Tom, on Brent. They see 112 in 23.
Yeah, the key thing to me is the 24-month view, John, based on demand. I mean, the bottom, and Amrita Sen has been wonderful on this, based on demand. GE is something, John, we got to cover it at some point here.
We can do that in just a moment, Tom. Tom Keene, Lisa Bramett and Jonathan Ferro. Your equity market turned around big time yesterday, and then this morning rolled over again. The Nasdaq 100 down 1.4%, the S&P down 0.9%. This is Bloomberg.
a lot of EVs coming to market. And I'm wondering, do you think that just the market share explodes and there's room for everybody? Or is there a specific market that you're going after right now?
At Vingroup and VinFast is the same way. We're building premium quality products for mass market. And we do expect that there's an irreversible trend to move from internal combustion engine vehicles to electric vehicles. So yes, the market share will expand.
How much money do you think you're going to have to sort of pump into everything right now? You also mentioned, this is an announcement from last year, that you're going to start a factory here in the U.S. Where are you in that? What kind of money are you looking to have to deploy?
So far, VinFast has put in about $6 billion so far into VinFast. And we plan to have a few more $1 billion investment.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
The bulls are still bullish and the bears are still bearish. Yesterday didn't change much at all for the south side. Your equity market this morning is negative another 1%. On the S&P, on the Nasdaq 100, it's down by 1.45%. Pick your poison. Morgan Stanley and Mike Wilson saying winter is here. Marko Kolanovic over at JP Morgan saying the bearishness is overdone. There is a big difference between their year-end price targets as well, which reflect those views. We go into tomorrow now. That Federal Reserve two-day meeting begins today, concludes tomorrow, looking for Chairman Powell. And it's going to be about the front end of the curve here. Switch up the board, a lift again, through 1% on two-year yields, up almost 5 basis points on the session. Does the chairman push back against higher expectations of more rate hikes, more balance sheet reduction? And what does that mean for how much we've built in through to the front end of the yield curve, so to speak? At the moment, on 10s up 2 basis points to 178.85, on 30s back through 2.1%. This has got my attention in the commodity market, so let's finish there, switch up the board and take a quick look at crude, WTI and Brent. WTI, 83.92, Brent just short of 88, coming back down again to 87. On the session, though, up 0.9%. WTI up by 0.7%. And Tom Keane this morning, Saxo Bank, looking for triple-digit crude the back half of this year. Energy aspects, and Amrita Sen looking for something in the 90s back half of this year. Tom, that's the story at the moment. Everybody just inching higher those year-end price targets for that market.
You wonder where the low-price oil people will capitulate and start to bring it up here. And again, it comes off global demand, including global demand in the Pacific Rim. I want to fold the story of General Electric into our monetary policy because I think they're directly linked. It was stunning 90 days ago to see GE announce a 3-company breakup. It is far more stunning this morning to see General Electric really put some meat on the discussion. And the discussion is simple. They've got 2 divisions, 2 new companies, getting it done, including GE Aviation. And they've got another one which they title Renewable Energy, Power, and Digital, where just simply it ain't happening. Claudia Sam is an industrial analyst, senior fellow at Jane Family Institute, and joins us this morning. Claudia, GE is a metaphor for how everyone, including Jerome Powell, is dealing with the structural changes of America. How does a central bank deal with industrial failure, industrial breakup, global competition, and at the same time deal with the technological boom as seen in the excellence of GE Aviation? What is an economist to do?
Right. Well, good morning. I mean, these are just one of the many questions that the Federal Reserve is puzzling over right now. I mean, frankly, I would put a lot more of it on consumer demand, but we do know that demand has been strong, and we have heard multiple times about the production, particularly of goods, not making up for the demand we have. And basically anything that's bad news on that front, whether it's COVID or problems in the production sector, I mean, this is not good news. But if you step back and look at big picture, industrial production and a lot of the consumer goods spaces, it looks a lot better now than it did even months ago. This is not saying much, but we need anything moving in the right direction here.
If corporations are clearing markets, including getting rid of the debris as General Electric is doing, do we assume consumer demand and the buoyant consumer demand is legitimate and sustainable?
Yeah, so having worked on consumer demand for over a decade at the Federal Reserve, I know that the biggest thing driving demand is income in people's pockets. And we have seen, particularly from the federal government, letting child tax credit expire, seeing millions of workers be out of work even 5 days. Like that, a lot of families cannot make that work. And they certainly aren't going to make it work and go out and buy big durable purchases that they can put off a little while. So I think we've seen a lot, and we'll see when we have the January numbers that's done more than a Fed increase is going to do in terms of pulling the demand out.
Claudia, there is a conflation between fiscal and monetary policy often, and people look to monetary policy to do a lot of things that fiscal policy have done years and years ago. I am wondering at this point, given the sense that you've long called for the Fed to be patient, you think that they're on track, they're not behind the curve, at what point do you see the inflation mandate becoming pressing and important for them to address at a time when it seems unclear what more they can do on the employment front?
Right. So I know the narrative is really gloom and doom right now, but we got to step back. We had unemployment move below 4% at the end of last year. Yes, we have had inflation, but we have inflation adjusted consumer spending, business investment, you name it. This is not stagflation, and fiscal and monetary policy really push that. And that is so important. It is absolutely appropriate, and we've seen this in messaging from Jay Powell and Lael Brainerd. We are so much closer on the maximum employment. And yeah, the thing that's not where we want it to be is inflation. So I don't think they've changed how they are valuing or kind of weighting the two. It's just we're a lot closer to the finish on employment, and that's a big deal for American families.
Although participation rate has not gotten back up, and this is something that people are concerned about, and given that it may not recover to pre-pandemic levels, people are starting to worry about a wage spiral. How are you thinking about that?
Yeah, so we have to remember the two things that push up on prices are supply and demand, right? And if consumers aren't out demanding, and Omicron's taken the winds out of some of the service sector, well, if the demand's not there from the consumers, well, it isn't there from the employers either. So I do think when we get the numbers for the fourth quarter, the good employment compensation index numbers, we're going to see some pretty big numbers in December. Unfortunately for the Fed, and this is for markets too, the information that we really need to understand where demand is going is January, and we do not have that right now.
We're data dependent and waiting out for the data. Claudia, a lot of good